I've made $3 million in just the past year trading and investing in crypto at the age of 19 and have helped hundreds of people across the world to scale their own portfolios. But the game is changing, and based on where we are in the crypto cycle so far, many analysts and I expect 2026 to be the very last time to truly capitalize on this crypto bull run. So if I lost everything today, this is exactly how I tackle 2026 to recreate the same results from this year, even if you're starting with zero knowledge. And you clicked on this video for a certain reason. Through the bull cycle so far, you've seen a ton of people making life-changing money, from 50-year-olds to teenagers making millions of dollars from thousands in a matter of hours, while you've been stuck in the sidelines or continuously losing on trades, not knowing where to get started. So my goal with this extensive free course is to make it better than every other guru out there, because quite honestly, there's a very strong gatekeeping culture in crypto which I absolutely hate. That's why in this video, I'm breaking down everything you see on the screen right now. From number 1, where we are in the cycle and what the future holds. Number 2, the setup. Number 3, how to find profitable coins. Number 4, risk management. And number 5, trading psychology. So if you really want to get results in 2026, lock yourself in and get ready to take notes, because I am revealing millions of dollars and years worth of knowledge. But right before we do, I'm going to make clear that I am not a financial advisor. Everything is my opinion, and I will never tell you to buy anything. I am here to give you my personal thoughts from my personal experiences. Now, let's get into it. So before you even think about trading, where are we in the timeline right now? Because we've been in a bull run for over a year now, and I'm not gonna lie to you, you are definitely not early. But we're not finished. The best thing you can do is to educate yourself on the current state of crypto and what it means for 2026. Looking at it from a macroeconomic perspective. Or else in the next year, you'll be scrolling past another 16-year-old millionaire story, wondering why it was never you. Now, liquidity is still flowing in a wide variety of sectors in crypto. Asset valuations are high, and even after the huge liquidations we've seen so far, institutional and governmental backing for the crypto market is still strong. So in layman's terms, the crypto market is still looking strong, but before we look at specific stats that support this, you need to change your perspective. Let's start by looking at the foundation of the entire market. If you're new, you're probably overwhelmed with the thousands of coins and new narratives that are coming out every week, and this is going to make it impossible to keep track of it all. So I'm going to make things super simple for you. Bitcoin is the leader. It is the very first thing you should use as an indicator for tracking the health of the overall crypto market. It's the strongest cryptocurrency with the highest market cap, most institutional backing, and it's what people think of when they think of crypto. And what does a leader do? It leads. Think of Bitcoin as an ocean. When the tide rises, all boats rise with it, even the ones with holes. That means, historically, when Bitcoin rises, other cryptocurrencies rise with it, even the ones that are less established or weaker. And historically, when it falls, the rest of the market usually sinks harder. I mean, you can see it right now at the time of recording, with Bitcoin dipping down 10 to 20% and every single other coin in the market nuking even harder. For example, Solana to Bitcoin, Ethereum to Bitcoin. Now, there are some nuances to keep in mind, of course. So if you keep just making mindless decisions based on Bitcoin's price alone without understanding what's actually driving it, you are not positioning yourself to profit in 2026. You need to also understand that there are going to be periods of Bitcoin or altcoin dominance, which is when one is outperforming the other in terms of percentage. For example, Ethereum is up 77% versus Bitcoin being up 60%. Solana is up 33% versus when Bitcoin is up 20%. And since early June, a lot of these Bitcoins are up against Bitcoin. So you could technically say we're already in an alt season and no longer in a Bitcoin season. And there are going to be periods of hype-driven narratives like AI coins, meme coins, or DeFi seasons where they can pump even when Bitcoin is flat or pulling back. And in some phases, Ethereum actually sets the pace as a leader for the altcoin sector specifically, like we saw during DeFi summer in 2020. And when I say altcoin, it just means any other cryptocurrency besides Bitcoin. But of course, in scenarios like these, Bitcoin still remains the overall macro driver and leader. And we can see this by just eyeballing the chart. We can see that it lines up. When Bitcoin rises, everything else goes up. When Bitcoin dips, everything else nukes much harder. Now, here's something people get wrong. Correlation is not always causation. For example, in the recent liquidation cascade of October 10th, other cryptocurrencies did not go down simply because Bitcoin went down, but it was instead a news-related event and a response in the market to Trump's new statement on tariffs. You can simply look at where Bitcoin is at if you want to track the health of crypto as a whole. And when Bitcoin is healthy, there is money to be made in every part of the crypto market, especially the on-chain space like meme coins, utility coins, AI coins, and a lot more. And this is exactly when you see these random kids online making millions millions of dollars. And when Bitcoin is healthy, it's the kind of market where anyone can start cashing out with insane profits. And I genuinely mean anyone. Inside my one-on-one mentorship, the system we use is built to perform in these exact positions. My students were able to secure huge wins, with some going from 2.3 million and beyond. That's exactly why it's so important to understand why Bitcoin sits at the center of the crypto market. Because now that you have that foundation, we can zoom out even further and start looking at the numbers that show where we are right now and what could be coming next. And that brings us to the next key piece of the puzzle: liquidity. And liquidity is just a fancy way of saying how much money and credit is in a financial system. When there's money flowing, risk assets can go up, and in the opposite scenario, when liquidity is dry and tightens up, assets fall. And this doesn't just apply to crypto. Every market, crypto, stocks, commodities, is affected by the flow of money. But in crypto, liquidity isn't just one part to look at, it's the most important, because crypto is the highest beta liquidity trade in the world, meaning that when liquidity rises, crypto outperforms everything, and when liquidity dries up, crypto crashes harder and faster than anything else. This is why every crypto cycle looks almost comical. It's kind of like a roller coaster. Huge euphoric blow-offs, then 70 to 90% drawdowns, and now you know that they're not random. They're an amplified reflection of liquidity. Now, to actually measure this, there's one stat that captures that big picture: global M2 money supply. Global M2 measures the global money supply, so cash, checking accounts, savings, money market funds, etc., from countries like the US, China, Japan, Europe, and so on. I used the ocean analogy for Bitcoin earlier, so in this scenario, think of M2 from a broader perspective as the ocean of the entire market. And some main drivers of this concept of global M2 as examples to give you a clearer idea are going to be: 1. Central bank balance sheets. So when central banks expand their balance sheets, they're essentially injecting liquidity into the system. 2. Cross-border credit creation. So when banks and institutions extend credit across borders, adding liquidity outside of just the central bank money that I just mentioned. Number 3, dollar strength or weakness, because a strong dollar is going to tighten liquidity worldwide, because most of the global debt that we have is denominated in dollars. Once again, fancy terms here, but all that means is that most of the debt in the world from loans and bonds need to be paid off in dollars. Now, when that very dollar that these debts need to be paid off weakens, global conditions ease. And number 4, sovereign flows of capital. So when governments and foreign wealth funds move money around, that can tilt global liquidity as well. Now, why does this matter for crypto? Because the crypto market is the purest recipient of these global liquidity outflows. It's a global risk asset with a market that's open 24/7. When M2 expands, liquidity rises, credit is easy, and risk assets like crypto rip. But when M2 slows or contracts, liquidity dries up, credit tightens, and speculative markets like crypto get absolutely crushed. This is proven historically. You can look at any M2 chart. So on this chart, for example, for comparing M2 global supply growth, year over year and year over year growth rate of Bitcoin price is in white and M2 supply is in pink. In 2020 to 2021, M2 ripped after the COVID stimulus and Bitcoin went parabolic and altcoins went exponential. In 2022, M2 stagnated after the Fed tightened and Bitcoin collapsed 75%. Altcoins went down 80 to 90%, and we entered one of the worst crypto bear markets in history. And quick reminder, when you're tracking M2, we are analyzing the crypto market on a macro scale here to really show you why we're at the moment and how much potential you can still juice. And a really interesting example, 2023 to 2024, US M2 was basically flat. We had contractions that hadn't happened since the Great Depression, and by itself and what we now know of M2, because you took notes, that would normally signal a weak backdrop for risk assets like crypto. But at the same time, global M2 pumped. We saw Japan continuing yield curve control and interest rates near zero, which meant Japanese capital flowed outward into global risk assets like US equities and crypto. We also had news that China was easing, loosening its monetary policy to counter their real estate crisis, and they were adding credit and stimulus that once again flowed outward into global risk assets. And the European Central Bank slowed its tightening campaign, keeping more liquidity in the system, and extremely important, the US dollar weakened. And you probably hear an exaggerated version of this kind of situation happening in the future all the time, of the dollar being obsolete and crypto replacing it completely. So what actually happened when the dollar weakened? Global liquidity expanded because, like I said, dollar denominated debt, so loans or bonds issued outside of the US that require repayment in US dollars, got easier to service, which as a result freed up more worldwide capital. Bitcoin pumped. Renowned analysts like Michael Howell founder of Cross Border Capital, has been tracking global liquidity for over 30 years. He consistently shows that global M2 growth and central bank balance sheets are the single biggest drivers of risk asset performance. Raoul Pal, ex-Goldman Sachs and CEO of Real Vision, frequently states that Bitcoin is the purest expression of global liquidity, pretty much arguing that when global M2 expands, Bitcoin acts kind of like a high beta call option on that expansion. Now, it's not perfect, but it's close enough to call it a principle with about an 80% correlation. Global M2 is directly tied to Bitcoin's pump and dump cycle, and right now, we are cruising through a global M2 money supply rally. And if we look at the chart, M2 growth has re-accelerated. We're in the middle of a renewed M2 rally, and Bitcoin is reflecting that strength with new all-time highs this cycle, and other major cryptocurrencies like Ethereum and Solana retesting those highs. Because you took notes, knowing how they act as leaders for crypto, you now know what this means for the cryptocurrency market. But global M2 doesn't go up forever. These liquidity waves always crest. No central bank is ever just going to ease on forever, right? Every wave follows the same exact pattern. So central banks ease, liquidity surges, and then markets pump. So when credit is cheap, when these balance sheets are expanding, when governments print or stimulate, liquidity flows into the system, and that is when risk assets like Bitcoin go parabolic. Think of 2020 and 2021, stimulus checks, zero rates, trillions in QE, liquidity surged, and crypto had its biggest rally ever. But then, liquidity pressures build, banks tighten, liquidity slows, and all of that liquidity creates problems. Prices rise, inflation takes off, and central banks are forced to pull back. We saw it in 2022. Inflation hit 40-year highs. Crypto collapsed, stock valuations shrank, and speculative sectors were absolutely destroyed. And then the business cycle peaks, and risk assets crash. Once liquidity tightens long enough, growth slows, credit contracts, and the business cycle turns over. We're followed by recessions, and risk assets get absolutely crushed every single time. The only thing that changes is whatever asset class is the main character right now. In the late 1990s, it was dot-com stocks, in the 2000s, housing, and today, it's tech and crypto. And unfortunately, analysts widely expect this wave to peak around 2026. Let's look at some reasons why. So number one, balance sheet runoff, so quantitative tightening. The Fed and other central banks are shrinking their balance sheets. Kaixa Bank projects that US bank reserves could fall to 10 to 11% of GDP by Q2 2026 if quantitative tightening continues. That directly removes liquidity from the system. Number two, inflation and rates. The current inflationary pressures will likely keep rates higher for longer, and these higher borrowing costs are going to slow credit growth and pull capital back into safer assets like bonds. Number three, weaker global growth. The end of year 2025 to 2026 outlook shows global GDP slowing. And this slower growth means less demand for credit and less fiscal power from governments, which is going to reduce liquidity injections. If the dollar strengthens again, it's going to tighten liquidity worldwide, and dollar-denominated debt becomes harder to service, which is going to suck capital out of emerging markets and speculative assets like crypto. And finally, regulatory and sovereign constraints. The stricter banking regulations and fiscal tightening in indebted countries like Europe and Japan are going to further slow money creation and cross-border flows. And if you put this all together, you can see why renowned analysts on global M2 expect global liquidity to crest around mid to late 2026. And that means the environment we're in now, the abundant liquidity, strong flows into ETFs, high volumes, speculative rotations on chain, is not going to last forever. And when the tide turns, crypto is going to collapse harder and faster than anything else, just like it always has. Put this all together and you can see why analysts like Michael Howell and Raoul Pal all expect global liquidity to crest around mid to late 2026. That means the environment we're in right now, the abundant liquidity, strong flows into ETFs, high volume speculative rotations on chain, won't last forever. When the tide turns, crypto will collapse harder and faster than anything else, just like it always has. So where are we right now? Well, first, Bitcoin is healthy. That almighty leader is still carrying our boats. And global M2 is rallying. So domestic liquidity has resumed growth. It's going to keep adding fuel to the fire. And global liquidity is rising. That ocean is lifting every single boat out there. But analysts expect it to crest around 2026. Now, within all this macro talk, what does that mean for you? Not for some Wall Street hedge fund, but for you, an up-and-coming trader trying to get rich off crypto. You are not early. Anyone BSing and saying that you are is full of shit. You've probably now heard of thousands of coins where people made a 20x, 50x, 100x return, but the potential to make life-changing profits is still there. Why? Because as long as liquidity is still flowing, those very same 20x, 50x, 100x opportunities are going to keep appearing. The waves are still rolling, the tide's still rising. That's why you need to act now. This volume on chain is not gonna last forever, and you don't wanna get caught with your pants down by coming in too late, getting screwed at the top, and having no capital prepared during the bear for the next bull cycle. And listen, of course, I could have just told you that at the start. Hey, there's still money to be made. Go trade. But that wouldn't teach you shit. And even when we look at the technical side, what just happened to Bitcoin on October 10th might look like weakness on the surface, but let's look closer. In the first week of October, Bitcoin hit a new all-time high backed by record-breaking ETF inflows. Then out of nowhere, a tariff headline dropped, triggering massive forced deleveraging across the market. And what followed was the largest 24-hour liquidation in crypto history, with over $19 billion leveraged, wiped out in a single day. We saw Bitcoin wick to around 106 to 107k, and by the end of the week, it closed back above this range low that we've been in for the past 4 months, with the total crypto market cap still being in the multi-trillion range. So when I remove all the noise, what does this tell me? It means that we just lived through the largest 24-hour liquidation ever, and Bitcoin still didn't lose monthly up structure. And although this chart might look ugly, that is range bound strength. And listen, of course, I could have just told you that at the start. Hey, there's still money to be made, go trade, but that wouldn't teach you shit. Now you know why. You understand the foundation. You see how Bitcoin and liquidity lead this market. And that knowledge is what's going to separate you from the 90% who will get absolutely slaughtered this cycle and every cycle after. And having this foundation is going to be so important in carrying on in the future and being aware of urgency. This is the kind of knowledge and education I want you to have going into the space. And if you don't have the patience to build this foundation, then I'm sorry to say this, but this market isn't for you. Click off the video right now for me. But if you haven't left after all that, congratulations. You are already ahead of 90% of the degenerate traders on chain who have no knowledge of fundamentals whatsoever. And before we move on, a couple final reminders. Correlation is not always causation. Bitcoin doesn't always cause alts to dump, though it can in many scenarios, and M2 charts don't cause crypto pumps. They reflect the underlying liquidity conditions. Crypto is simply the highest beta expression of that liquidity. Keep that perspective. Don't fall into this lazy cause and effect thinking. And by the way, I'll be talking more about this lazy thinking that I've been seeing so much lately later in the video. For now, just remember, track liquidity and respect it as an indicator. For example, if right after watching this first step, you think you can just tail M2 and time the top and bottom of Bitcoin, you're on the wrong path. That's not how this works. There is no all-powerful cheat code in crypto. Understanding macro conditions gives you awareness, but it's not going to trade for you. But with that understanding of the backdrop, you're now ready to actually start your journey up in the charts. Because although knowledge might make you feel smarter than everyone else, knowledge alone doesn't make you money. Execution does. And execution starts with having the right tools, platforms, and systems in place so you can actually capitalize on this strong liquidity. And this is exactly where most people get stuck. They learn, they research, they understand liquidity, but they have no idea how to actually turn that into trades. This is where tools, systems, and real guidance matter most. And inside my mentorship, this is the part that flips the switch for people. We go from understanding the macro to building actual setups that are built to win in this market. Because once you know how to spot the opportunity, the next step is learning how to actually capture it. And this is exactly where step 2 comes in. So before you even think about trades, what is the right setup? So your weaponry. This will probably be the easiest part of your entire journey since this is all just physical preparation, right? If you're a beginner though, this part is really crucial since crypto is still extremely fragmented in almost every single area right now. So we're going to be integrating several different sites and tools. So the first thing you're going to need obviously is a trading device. For my first year of trading crypto, I did everything on a MacBook. I genuinely have no idea how I managed to do it, but I somehow made it work. In reality, you should be trading on a PC, something that's going to give you the most accessibility and flexibility, right? You're going to be switching between so many different tabs, your trading terminal, Twitter, websites you're researching, whatever communities you're in. And doing all this on anything but a PC is just going to give you a massive headache. And you don't need to add any unnecessary struggles on your journey. So get a PC to trade with. Next, the actual apps you need to trade with. And to make everything so much easier on you, I'm going to divide this into different sections. So the first is going to be your news network. Crypto relies a lot on news and events, and some coins are even created from certain pieces of news that are related to memes, crypto, or finance, so having proper information inflow in order to stay updated is extremely important. Now the problem is, in crypto, there's a lot of noise and there's no set single quote-unquote data center you can check every day, so it's really easy to get lost and unorganized. What comes closest to that though is crypto Twitter, and I cannot stress this enough. You need to take your Twitter feed seriously, cut off all distractions, make a new Twitter account solely for crypto if you have to, because it's Twitter, right? There's going to be a lot of noise with no value. What you're going to do is curate it intentionally. You need to follow accounts that provide value and information. If I just open my Twitter feed right now, for example, it's all crypto related content and news. Most of the timeline is going to be reported on Twitter because that's just the way crypto is right now. I don't make the rules, so make the most of it. Just to start, here's a checklist. So accounts that post about macro, reputable TA accounts, so technical analysis accounts that post about financial news, accounts that are influential figures in the crypto space, accounts that have massive attention in crypto at the moment, whether it's from a huge play they hit recently, so main character accounts, and accounts that are smart traders and give insights on the market and mentality. Obviously, you're not going to be able to identify all this if you're a complete beginner, so I'll give you a list to get started. Take a quick screenshots and follow the accounts here. What you can also do is go shopping on my following list for more examples and do some self-guesswork on what you think they fall under. For these strictly crypto related accounts, you should also go to their following list and follow who they're following. But once again, just be aware of clogging your feed with noise. And remember, I'm not telling you to follow what they're saying, treat what they're saying as gospel or anything like that. The whole point of this is to just curate your Twitter feed. If your feed just looks like a bunch of accounts farming engagement and replies, or a shameless shilling of coins, you are doing something wrong. But if it looks kind of something like this, you should be good to go. And a really good principle to stay by is if you're not getting any value out of an account you're following, meaning you are not making money off of their calls or becoming more educated by reading what they're saying, unfollow the account. And the only exception I could say to this is if that account is the current main character of crypto right now, and they have a lot of motion from an extremely successful recent call or big news, because if they do, obviously whatever they're saying is going to influence the timeline at the moment. I really want to emphasize how important it is that you cut off noise. Crypto trading relies so much on experience, and I know that sounds super generic, but information inflow is part of it. And once you spend more time in this space, you will get better at identifying which accounts to follow and which to ignore. Another app you need is Telegram, and this used to be pretty much mandatory for information purposes in the past because it's where every new coin would post updates, but right now very few coins operate there anymore. But the bigger reason why I want you to have Telegram is because one tool you absolutely need to trade with, which I'll help you set up after this information inflow section, operates on Telegram. For information purposes though, there are some solid accounts that also post market insights and TA on their dedicated Telegram, which you can look at for just staying updated or if you want to compare your own. Just be careful with the security risks since of course there are going to be some shady people there. It's Telegram. One thing I would be cautious about though are any quote unquote free Telegram alpha groups. And I don't mean the ones that share like market insight or macro or actual information, but those that just shamelessly promote coins and nothing else. They're probably just coins that they've created themselves. So quick but important, I guess, security notice here. Just be careful of those. And another app to set up is Discord, since it's pretty much where every crypto trading community is going to operate. For example, I can just give a quick look into my own Discord where I personally help out other people. I can look at other people's scans and theses. I can drop my own market insights, coins some of us are looking at. Just makes everything super efficient, and you're going to see a similar format like this in other crypto communities out there. Now, I'm not saying you need to trade with me, but if you want to speed up your learning curve, you should absolutely find a solid crypto-oriented group. You can find a bunch of solid paid groups on Twitter as well, even if it's just a few friends or a small circle of traders. Having people to exchange information with will make you learn and grow as a trader much quicker. And this shouldn't be here. So all in all, Discord, honestly less optional, more mandatory, especially if you want to speed up the learning curve. So when it comes to information inflow, these three apps, Twitter, Telegram, Discord, will more than do the job. Twitter's going to act as your real-time news terminal. It's going to give you narratives, updates, early signals from smart traders and developers. Telegram is going to keep you updated on certain coins and market insights. And Discord is going to give you a community to trade ideas, share research, scan with other people, and analyze the market together. These will give you a constant flow of raw data and discussion, and that's really the foundation of crypto trading. The market moves fast and mostly off information, and if you set these up well, you should always stay up to date of what's happening on the timeline. And by timeline, I know I've repeated that word several times already. I'm referencing to the current events in crypto, so any significant events that are happening right now. And next step, so before we actually go over what trading terminals and tools you should be using to actually trade, how do you actually buy crypto? Once again, if you already know the setup, gonna try and make this as fast as possible, but pretty much all you need to do is head to any centralized exchange that operates in your country. So that can be Coinbase or Kraken if you're US based, or Binance if you're in Asia. Just find one that's reputable. You can head to top crypto exchanges ranked by trust score here on CoinGecko. I wouldn't use anything that's past 0.6. So focus on these specifically. So sign up, do the KYC, remember to pay your taxes, and just buy whatever crypto you're going to be trading with. For the purpose of this video, I'm going to be going over a lot of on-chain trading. So actually use the crypto in question as currency to trade coins on their chain rather than actually buying and selling spot. So I would recommend getting exposed to Solana, BNB, and Ethereum. Not to hold spot and trade, no. This is so you can have currency ready on-chain. Since most on-chain plays usually occur on these three chains, this is just to have money ready to deploy. And if you need to bridge, so let's say you want to swap your Solana to Ethereum or another kind of crypto that's hard to buy, like Base ETH, which is pretty hot right now at the time of recording, you can either bridge on the exchange you're using if it supports it. So on Coinbase, I can bridge to BNB, Solana, Ethereum, Base ETH, whatever. Or you can use an outside bridge app like dBridge here. Just be careful you're not using any fake sites. And one thing I'm going to say right now is these centralized exchanges are only used for buying and selling crypto. Do not keep money on centralized exchanges. You don't ever want the possibility that they freeze your funds. But once you have some crypto, let's say I bought some Solana here, you need to set up a hot wallet. The only two hot wallets you're going to need are Phantom and MetaMask. Just add the Chrome extension for these, and the setup should look something like this for both of them. So this is Phantom Wallet, and this is going to be MetaMask. So Phantom Wallet is going to be for everything Solana related, and MetaMask is going to be anything EVM related. So this is anything in Ethereum, Base, BNB, and what you're going to do from here. So let's say you have Solana from Coinbase. You're going to withdraw it to the Solana address on Phantom Wallet. So for me, that's going to be at the very top right here. And if you want to withdraw anything on EVM, so Ethereum, Base, BNB, Tron, I can withdraw it to my MetaMask over here at the very top. And to switch between these networks, you can click over here in all popular networks and switch between any supported network on MetaMask. Very simple and easy. Okay, so we've made some progress here. You should have crypto to trade with on your Phantom and MetaMask, and a solid way to gain information and exposure to the crypto space every single day. Now, we need to set up our actual trading terminals and trading tools. So how can we actually execute trades and help look for coins? For this process, I'm going to talk about a few tools and terminals that are necessary to trade with, and at the time of recording this, provide pretty much everything you really need, fulfills every purpose. I don't use anything else besides these tools, and I don't recommend you use anything else besides these tools, since there are a lot of shady apps out there, and there's nothing better than these at the moment. First thing you need to set up is Axiom Pro. Axiom Pro is an all-in-one trading platform designed specifically for on-chain coins on Solana and BNB. It's going to give you absolutely every single feature you need. It's going to give you a real-time tracker of every single coin on those chains getting volume, a built-in Twitter tracker, a built-in wallet tracker for both chains with live alerts, a bundle checker, so kind of a scam detector on every coin. It has a built-in futures trading system and a fee rebate system, so you get a small refund for every single transaction you make. And they're the most secure trading platform in all of crypto right now. They're backed by YC. You're not going to get any security issues with Axiom compared to other trading terminals that are built by anonymous developers. You don't have to deal with any of that BS. It's pretty much the ultimate trading tool for every Solana and BNB coin, and without it, you are trading blind. So let's get into how to set up Axiom. First, go to the link in the description and make sure it has the referral code Fortune at the bottom right here. And through that code, you're going to get 20% off every single fee, which is the lowest compared to what all Axiom users are getting. And once you're there, you can sign up using your email, your Google account, or by connecting your Phantom wallet, which I showed you how to set up before. So I'm going to hit connect with Phantom. Confirm. So once you're here, you're gonna get a private key. Write this seed phrase down, store it somewhere safe, offline, because this is the only way to recover your Axiom wallet. And once you're signed in, you're good to go. And now let's talk about how to actually use the platform itself. Because I'm not gonna lie, it is pretty easy to get overwhelmed with all of the features that this has. So first thing you're gonna land on is the trending tab. You're gonna see every single coin that's getting volume right now on Solana and BNB. You can use this little button here to switch between those two chains. Next, you're going to head to the Pulse tab, and this is where every single new token is going to appear in real time. So this is going to be your radar, right? But looking at it straight up, once again, very easy to get overwhelmed. There's so many new coins popping up in your face every single millisecond. So to break it down little by little, the left column is where every single new coin is going to pop up in real time. The middle is for when new coins are close to what's called migration, which is when a coin reaches a high enough specific market cap to move to a separate liquidity pool. And that's when it goes into the third column. So this is where every single newly migrated coin is going to come up. And I'm going to tell you right now, 99% of the coins that pop up here are garbage, right? You're going to lose money trying to trade these poor quality coins. So keeping a level head and not buying everything you see getting volume is my first important tip of navigating Axiom properly. Now here's how you're actually going to set up. So for the new pairs, you're going to hit this little filter button and you're going to head to metrics and you're going to go down to global fees paid. Make sure that's 0.1 and minimum market cap at 11,000. Apply all. For the final stretch middle column, you're going to go to metrics once again, go to global fees paid, make sure that says 0.5 minimum. Once again, 11,000 minimum market cap, and you're going to hit 8,000 volume. Apply all. And for the migrated section, 3.5 global fees paid in SOL and 11,000 market cap once again. This way you're going to filter out a lot of that 99% garbage that I was talking about. And if you're new, I'm going to give you some advice right now. I want you to focus only on the migrated section, the third column right here. Why? Two things. Number one, the coins that actually migrate are, of course, going to be much higher quality coins out of the tens of thousands of new coins that are going to be spawning daily. Because these coins need enough people buying in to even come up in the migrated section in the first place. So these are going to be coins with better narratives, more volume, and you now have a much smaller pool of coins that you actually have to analyze a day, and therefore give you a much higher chance of actually catching a runner. And number two, it's going to build discipline and train your analyzing process in a more healthy manner. Because one of the biggest mistakes I see from a lot of new traders is thinking they can scalp every single fresh pair for a couple % gains and somehow stack that up over time. That's propaganda. Let me be clear, you are not that good right now, and that kind of strategy is honestly something I would never recommend to anyone, even someone with experience. Anyone who's making money like that is either extremely experienced with scalping, or they're very influential and they have copy traders so they can buy anything and people are gonna follow. And when you're prioritizing that quantity over quality mindset, you're forced to chase coins with very short-lived narratives. You've got to be extremely precise, and it only takes one trade, one unlucky scam, one unlucky rug, one unexpected factor, and boom, every single small gain you built up little by little is just gone in an instant. Me personally, I can watch every single column, but that's only because I'm experienced enough to instantly know what coin could have potential in an instant. And I will be going over how you can identify good coins later in the video, but for now, if you're new, I want you to only focus on this third column over here. And within every single coin, you can see these little logos that come up. So I'm gonna go over them one by one. The first little logo that you can see here is going to be the socials attached. So this is likely going to be the Twitter. Over here, for example, New Yorkistan, it's a community Twitter page on that coin. And the next is going to be the website attached for the coin. So once again, for New Yorkistan, if I open up the website, it links me to the TikTok page of New Yorkistan. I'm not logged into TikTok at the moment for this Chrome profile, so I can't really see what it is, but you get the point. And the search logo, really cool feature. If I click it, it's going to automatically put in the contract address of the coin into Twitter, so I can instantly see any information about it on Twitter. And to the right of that are going to be the amount of holders in a coin and the pro traders, and how Axiom flags this are going to be wallets with actual volume. And if I go down, so the first is going to be the top holder percentage. So what percent supply of the coin is being held by the top 10 wallets. And to the right of that is going to be how much the developer has of the coin. If it says DS like it does for this, it's going to mean the developer sold, and what they were funded by on the right. So over here, the developer is funded by Binance, and to the right of that is going to be Sniper's holding. So how much of the coin was bought on the first block. To the right of that, insiders. So this is going to be wallets that were sent supply from the developer wallet. And to the right of that is going to be the bundle percentage. So this is just the percent supply that is held by wallets that bought on the same block. So you can kind of think of this as the percent supply that is being held by a few individuals. Now, no trading terminal is going to have a perfect bundle percentage indicator, so I wouldn't really pay too much mind to this. Just be careful if it shows some egregious amount like 40, 50, 60%. And to the right of that is going to be the DEX paid. And if you don't know what this is, it just means that whoever was running the coin paid for it to get promoted on a popular research tool called DEX Screener, which I will get into very soon. So these icons are going to give you a very brief yet informative view of a coin before you even open it up. Now for your priority fees, you can honestly just keep it like this. It'll automatically adjust to the lowest setting needed, and make sure it says slippage at least 30%, because a lot of new coins that you're going to see are going to fluctuate a lot in volume and in market cap. So it's important that your slippage is high so you can actually get in at an appropriate market cap. Meving is kind of a thing of the past, but I would still check this off anyways. Now, if you really want to snipe a coin, let's say you know a coin is coming up, you want to get in early, you can change the priority and bribery to whatever number that you're willing to put in, 0.1, 1, if you're really ballsy. It could also be something lower like 0.01. And contrary to what they say, the bribery is actually more important for sniping than the priority. So make sure you pay more attention to that. But most of the time, you can just keep these at 0 and you'll be fine. And even at the minimum fee, Axiom is the fastest bot on the market. They have their own RPC. So Axiom is going to fill you out faster than any other trading bot out there. Now let's get into the Twitter tracker. A lot of profitable coins that come up in this market are news coins. So coins that are made from some interesting news about crypto, or just a really memeable tweet from someone influential. And this is where the Twitter tracker comes in. So you will get a live alert from every single tweet from any account that you put in to track. So if I click customize feed, go to top subscriptions, and if I put in influential account with a lot of motion, so let's say I told you to follow this account before, Black Noise 06. It's going to come up. If I had to pulse, I click Twitter at the bottom. I can just drag this right here, and it's going to show every single tweet that comes up from him on the left. I've made hundreds of thousands from catching trends this way, and some of the biggest P&Ls that you've seen from me are from tracking tweets. But I don't want you to become reliant on this alone, because these Twitter pumps can be powerful, but they're also very short-lived and extremely noisy. And if you're chasing every single narrative that you see on Twitter, you will end up overtrading and get trapped in coins that zero out instantly. So use this tracker more of as a signal, but always do your research and see if it's worth buying in before going blind. And once again, I will go over everything you need to know about finding good coins later on in the video, but for now, I'm just trying to take care of your setup. So just follow what I've shown so far. Next, the wallet tracker. So if I click trackers once again, I go to wallet manager. I can click add wallet, and I can add any wallet address that I want, and it's going to track that in real time. So let's say I want to add Gake's wallet. He's one of the most influential traders. I can keep the ghost emoji right here, add Solana wallet, and it's going to alert me anytime Gake buys into something. And I can also track the wallet stats as well to see how they're performing lately. And if I go to Pulse, I can open up the wallet tracker right here, move it anywhere comfortable, go to trades, and any trade that Gate takes will show up on live time right here. Now, one thing I do not recommend is copy trading. One of the easiest ways to wash your portfolio. When you're copy trading, you're buying into a coin with a narrative that you know less about than the one you're copying, and at a much worse entry because you're buying after and competing with that wallet's copy traders as well. So you're stealing someone else's conviction for a worse entry, and that's the complete opposite of what I want to teach you. And instead, you should be tracking wallets just to stay updated with what's getting attention, decide if it's a good narrative yourself, and then decide whether or not it's buying in. But regardless of that, the copy trade feature is a huge edge, especially if you're still building your own system. And you can find wallets yourself that are more anonymous and have a consistent track record of copy trade, all the better. Now, the next piece of setup that I'm going to show you is something that I don't see enough traders taking advantage of inside Axiom, is the built-in multi-wallet feature. So if I click wallets, as you can see here, you can make as many wallets as you want, put money into any of them. And if I buy into a coin with, let's say, 10 SOL with 3 wallets that have money in each of them each, it's going to disperse the amount of supply you're getting with 3.33 SOL in each one. And if you're working with higher capital, you should absolutely be splitting across multiple wallets for both picking up more supply and organization. And especially with these newer coins that are at lower market caps, having your supply dispersed throughout multiple wallets will make you not come up on the top holders list, which is great if you're trying to, number one, pick up a lot of supply, and number two, keep your wallets private, because a wallet holding, let's say 5% of a coin, is much more scary than a wallet that looks like it's holding 1. And if you hear people crying saying, oh my God, why are you telling people to bundle? Or That's not healthy for the chart. I want you to ignore them, right? My duty for you watching this guide on everything there is to trading and investing in crypto is to get you to make as much money as possible. And at the end of the day, I'm going to say this every single time. There are winners and losers in any fair market. And if you are not part of the winning side, you are a loser. So some people might hate me for saying this, but go ahead and start multi-walleting. And another very underrated feature of Axiom is the fee rebate system. And unlike a lot of other trading bots that just eat away into your capital, Axiom actually rewards you for using their platform. So every single trade you take, you're going to get a small refund, a small percentage of the amount that you traded with, and that's going to be credited back into your account. So very subtle, but over time, it's going to add up. Especially if you're a big trader like me, it's going to save a lot of money in the future. And now let's get into the built-in future system. A really cool feature that Axiom has is that you can actually trade perps on their platform, which is something that no other trading bot has. They use Hyperliquid's API, and if you have some experience in the space, you probably know what Hyperliquid is, but it's literally just Hyperliquid perpetuals. Very convenient to have. You don't need to hop into another exchange. Just pick a listed coin over here you want to trade futures on at any time, all decentralized, so you don't need to put in any information or anything. And I do use this occasionally. Very useful if you ever have a situation where you're like, oh crap, I need to long or short this immediately. Axiom perps are going to do the job just fine. Second thing you need to set up is BasedBot, and I'm going to attach all these trading terminal links in a doc down below. And notice how Axiom is completely centered around Solana and BNB. BasedBot, on the other hand, is a Telegram trading bot for every single coin on EVM. And like I said before, EVM stands for Ethereum Virtual Machine. Very easy way to interpret that is pretty much every single important chain outside of Solana. So Ethereum, Base, Tron. And if you're already pretty crypto familiar, you might be trading on Solana and BNB already. But so many opportunities recently have been on EVM, and the opportunity has, at times, outperformed trading on Solana and BNB. So you should already know by now, after I taught you how to set up Coinbase, having liquidity ready on different chains is super important, which is why I'm going to show you how it works. So for trading on EVM, you're going to use BasedBot. It's a Telegram trading bot rather than a web-based one like Axiom, and this is why you need to have Telegram set up from before. So head to the doc attached in the description down below for the setup link, and it should look something like this on Telegram. Not as many features as Axiom, but the main purpose of this is to actually let you execute trades. Why over other EVM trading bots? Well, BasedBot is going to support pretty much every single EVM layer out there, because even right now, a lot of EVM trading bots don't let you trade on chains like Zora. Now, in terms of actually looking for coins on EVM narratives are usually much more quality over quantity-esque than Sol, and because of this, pretty much every single profitable EVM coin I found has literally just been by doing research on Twitter, especially because most EVM coins that do well are going to be older coins that have been around for sometimes over a year. This is why, once again, it's so important that you curate a solid Twitter feed to really get that information inflow. And you'll stumble upon a lot of EVM coins randomly that you can just research. So right now, just pretend that I'm like your professor, looking over your shoulder, checking your classwork. I want you to make sure that you're using the right and official links and platforms. So follow some accounts, play around with them a little bit. Screen time and actually putting in the hours yourself is the most important thing when it comes to trading. So experiment a little bit. And I'm not telling you to go look for coins and trade immediately. No, absolutely not. And I know that after watching this, you will get that same itch that I had, when I first started, right before I instantly blew my portfolio for the first time. But just get used to some of the features, make some insights, because from here on out, every single bit of information that I'm going to talk about after this, I will automatically assume that you are comfortable with the tools and features that I'm talking about. Okay, let's address the elephant in the room here. Crypto is full of noise. If you have played around with crypto Twitter after step 2, you can pretty much see exactly what I'm talking about. I mean, everywhere you look, there's going to be an endless stream of distraction. There's going to be Twitter doom posting that makes you think the market is going to collapse every other day. Tweets like these, Cyril XBT. No one's going to say it, so I will. This has been the most disappointing bull run in the history of crypto bull runs. Another comment like this as well. There's also going to be bullish hopium that convinces you that every dip is going to be a guaranteed profit opportunity. There's going to be people shilling their coins after they've already ran, not because they actually believe in them from that point, but because they need you as exit liquidity. And there's going to be engagement posts from people who just want clout that add no real value. Because of the noise, people lose the ability to think for themselves. Instead of developing independent conviction through independent research, they become followers. They buy into overcrowded trades because everyone else is buying and chase whatever's trending on Twitter or Telegram. And guess what happens? They get dumped on, and even if they get lucky that time, they end up net negative in the long run. I experienced the exact same thing when I first started trading crypto. I started with a $500 deposit to trade Solana on chain, which was a lot to me back then. I was just a regular college student. And on the very first day, I full ported a call on this Telegram channel that I was following because they had decent calls in the past. And guess what happened? Every single dollar I put into that call, gone. I lost every single dollar that I put into that coin. I had to start from zero again. I knew the journey would be rough, but losing every single penny on my first day was not something I expected. Crypto is so brutal to people who think this way. It is not as simple as buying whatever's hot, whatever you're seeing on YouTube, on Twitter, and watching it go up. It's the complete opposite. By the time something is obvious, the real money has already been made and you are exit liquidity. A little bit ironic hearing this on YouTube and it sounds super generic, but please listen to me. Every successful trader will tell you the same thing. You cannot outsource conviction. Trading in any market, but crypto especially, is a game of you versus everyone else. You need to be able to do the research yourself. And this is why we've been building the foundation from the top down from the very start of this video. I am actively training you to do this throughout this course. We looked at the macro picture. We broke down why liquidity is the ultimate driver of markets. We know how BTC dominance works, and we've got our weapons ready, because the reality is, past all this noise, I will tell you right now, trading crypto is actually pretty simple, but it's not easy. There is no silver bullet. There is no magic indicator. Profitability in crypto is a process. Stop asking bullshit like, oh, is this coin good? There are so many different factors behind a coin, and it's why I really hate making blanket statements in this space. And all of this comes down to one singular concept that separates those who can find profitable coins in this game and, the blind sheep doing whatever, and that is identifying your edge. So, what is edge? Edge is the repeatable advantage that you have over the rest of the market. Think of it this way: in any competitive field, soccer, football, poker, video games, business as a whole, the winners in any of these fields here are the ones who know what their advantage is over everyone else and how to execute that advantage. Trading is the exact same way. Edge is what helps you find the profitable coins and stay consistently profitable. And if you don't know where your edge comes from, I'm sorry to say this, but you don't have one. Without an edge, you are just like a blind sheep gambling without being able to think for themselves. So now you're probably asking me, okay then Alex, how do I find my edge? Well, after years of experience and millions of dollars in profits and losses, I have concluded that edge in crypto can be broken down into 3 foundations, and these are the 3 filters I use every single day in the framework I want you to fully master. Number 1, sector flow, understanding which sector in crypto liquidity is moving towards and why. Number 2, narrative analysis, understanding how powerful the story behind the coin is. And number 3, risk to reward, so measuring whether the trade is actually worth it. These 3 concepts are what I call the puzzles of edge. You can find your edge in any singular one of them, and this makes these 3 the most powerful concepts in crypto. You don't need a million different indicators. You don't need to look at a billion different statistics. You just need to understand these 3 filters clearly. And if you can apply them consistently, you will develop your own conviction. You will learn to think independently, and you will no longer need to rely on anyone else's calls. You will find profitable coins if you know these 3, because the reality is, finding coins is the easy part. There's no shortage of them. I mean, there are over 30,000 new coins being launched on Solana alone. The work and your edge comes from actually being able to sort out which ones are valuable. To preface though, the 2 best places to look for coins are number 1, hot sectors. Obviously, you'll be trading wherever volume is. For example, let's say robotics coins on Base chain are super hot right now. Then you should be staying updated with popular influencers on Base, researching every single protocol and project you're seeing on Twitter about robotics on Base, and making a watch list of them. If, let's say, BNB meme coins are super hot right now, you should be sitting on the BNB new pair tab on Axiom. If it's on-chain Solana coins, you should be sitting on the pull section for Solana on Axiom. Like I said, millions of coins, but how do you know which ones are good or not? And I've ordered these 3 concepts in this specific way for a reason, because if you're completely new, you can't jump right into coin narrative analysis or risk to reward without first knowing the most basic thing, which is where money is actually moving. So before we talk about valuing any individual coins, we need to start at the root, which is sector flow. Because if you don't understand sector flow, you will just end up wasting your time analyzing coins in dead sectors or sectors with little potential. But if you do understand it, you will immediately be able to filter out 90% of the noise and find an advantage over everyone else. So let's start with my first foundation of finding your edge, Therefore, knowing how to find good coins, sector flow. So what is sector flow? Sector flow is simply where liquidity is moving inside crypto and why it's moving there. And when I say sector can mean literally any group in crypto. This can be something really broad like meme coins as a whole, or an entire chain like Solana or Ethereum, or it can be something really specific like dog meme coins, AI meme coins, robotics coins on Base. The point is, a sector can be as wide or as narrow as the market makes it. And when understanding sector flow, the golden rule you need to keep in mind is that liquidity never stays still. It rotates, moving into one sector, then pumps everything inside, and then leaves to the next opportunity. Now, why does this happen? Well, it can be a couple of different reasons, but the main ones are number one, poor sentiment. So traders lose excitement, hype dies down, attention shifts somewhere else, dried out capital or dried out narratives. So the easy money has already been made and people coming into the sector just don't see big upside anymore, or the narrative of why liquidity flowed into the sector in the first place doesn't look so good anymore. Or number three, it could be outshined by a different sector. Crypto is an attention-driven market. When a hotter, shinier trend comes up, capital abandons the old sector and moves on into the new one. Your job before you identify any individual coins to bid is to identify which sector liquidity is targeting and then narrow down inside that sector for the highest performing plays. So this is like knowing where the ocean tide is rising and then finding the strongest boats on that tide. So why is this important to know? Crypto is an ocean made up of lakes. I keep using like this ocean analogy to help you understand this. It's the same rise and fall together theme that I've been using this entire time. The same way when Bitcoin goes up, every single crypto in the market goes up as well. If a leading AI coin goes up, every single smaller AI coin that's similar to it is going to go up as well. So you can think of these sectors as lakes within this bigger ocean of crypto. And some lakes will receive more water than others at times. So we need to look at this wider perspective before going into any individual coins. We need to direct our focus not on a single coin, but a group of them. So why else is this important to know? Obviously, the act of front running a sector, so being in coins part of a certain sector goes up, you're going to get instant profit immediately. Rising tide lifts all boats. Number two, edge is always created in the early stages of a sector. The first stage of a sector cycle is where all the easy money is made in crypto. And you'll see exactly what I mean when I say this, when I explain this later on. And it filters the entire market. Instead of staring at a million different coins, you focus on these sectors where liquidity is actually flowing in and the ones you believe liquidity will flow to next. That focus alone cuts out so much wasted effort and time. Now, it's not enough to just know that liquidity rotates, right? We've made that very obvious by now. You also need to know how it rotates, and every sector follows the same anatomy, the same come up, the same peak, the same downfall. And if you can spot which stage a sector is in, you gain a huge advantage over everyone else who's just guessing. So to make this extremely easy to understand, I've created this sector flow cycle chart. Liquidity will flow in and out of every single sector in crypto in this same predictable cycle every single time. So number one, we've got euphoria. So this is the ignition point, right? Where coins in the sector that have just received massive liquidity run insane. So valuations are put extremely high and anything even loosely tied to the sector pumps extremely hard. And in this stage, even shitty projects with no real fundamentals, they moon simply because there's so much liquidity being deployed and everyone wants to hop in. Then we get to fatigue. So this is when too many coins and projects are launched within that sector. Everyone starts copying the same trend and running coins that are the exact same with just slightly different narratives, and liquidity spreads more thin. Coins stop making new highs as easily, valuations decrease, and traders start to become really picky here. Then we get into cooked. So the sector is just fully exhausted. Sentiment turns sour, the leading coins within the sector break down, and new launches within the sector are almost instant flops. At this stage, liquidity has already started leaving, and anyone buying in instantly assumes the role of exit liquidity. Then we get into rotation. So capital fully moves somewhere else, either into a new sector that starts to rip, or more commonly, spreads back into the market with no leading sector until there's reason for one to explode, in which we get back into the euphoria phase, then fatigue, then so on, so on, so on. It's a cycle. And I've had students use this exact simple breakdown to successfully time entire sector rotations. While everyone's still guessing, scrambling about, they're able to identify the phase, position early, and ride the entire move from build up to blow off. And in multiple cases, these rotations turn into profits like these, sometimes within just a few weeks. So please keep this cycle and its phases in mind when you're trading. This chart alone is so important in truly understanding sector flow because it can get you results just like we have for those in my mentorship. Okay, so theory's cool, right? We know how money moves in crypto and why, but how do you actually identify where you are in the cycle of the sector you were looking at? Well, there are a couple indicators which I've used that work best, but before that, you need to recognize the size and the scope of the sector you're tracking. This is extremely important. Remember, sector flow doesn't apply to just one thing. It applies to every single group in crypto, big or small. It could be huge and broad, like Solana on-chain as a whole, with billions in liquidity and a large amount of statistical data you can track. It could be medium-sized, like Solana meme coins or Solana AI coins, with still lots of projects, hundreds of millions of dollars in volume, but a little more niche, or even more niche, like a specific meta of Solana meme coins, like Solana coins from a specific launch pad, where there are only going to be a handful of plays, there's thinner liquidity, and it's harder to get clean stats. And because of this, the indicators you use and the weight you give them will vary. Number one, project launch quality. Easiest to gauge, and personally, I would say it's the most useful, and it's applicable to both larger and more niche sectors. So pretty easy to eyeball. In the euphoria stage, everything's gonna gain traction, super high ceilings. All using project launch quality as an indicator is asking yourself, how are new coins within that sector performing? In the euphoria stage, everything's gonna gain traction, super high ceilings, but in the late stage, only high quality projects survive, and you'll see coins with the same exact narrative as coins you saw in the euphoria stage flopping when the one during the euphoria stage exploded. Only thing I'd be cautious here. So real quick, Solana meme coins. I can head to Axiom, Pulse. I can look down the migrated section, realize, okay, there isn't shit going on. Solana meme coins are kind of not doing too hot in terms of volume. And if you're watching this with a little bit of experience, you know exactly what I'm talking about. Whereas robotics coins on Base right now are doing super hot. We saw Sapien get listed on Binance, shot from 30 million market cap to an all-time high of 140 million, which we called out in the mentorship. So using project launch quality as an indicator in this example, robotics coins on Base could be entering euphoria. Solana meme coins are in the fatigue to cooked stage right now. Now, the only thing I'd be cautious of here is in smaller sectors. A single strong project might mask the fact that the rest of the sector is still cooked. So make sure to apply this to a wide range of samples when doing your research. For example, you could see like a dog meme coin on Solana going to like 1 million maybe. Yeah, sure, that's decent compared to the rest of the market right now, but that doesn't hide the fact that Solana meme coins are pretty cooked right now. Now, the next indicator you can also use is looking at sector leaders. Also very easy to gauge and very useful, applicable to both larger and more niche sectors. Logic here is pretty simple. You know, you're using the chart of the leading coins in a sector as a way of gauging where the sector is. Euphoria is going to be the initial run-up of the leaders in a sector. Exhaustion is going to be on chop and downtrends, and cooked is when they nuke. Multiple examples we can use for this. So for Solana ICM coins, for example, ICM means Internet Capital Markets, basically coins centered around getting funding for products. We can use Launchcoin, the reason for the entire sector moving up, because this was the leading coin of the ICM sector. It was the highest market cap. On the initial run up to 300 million right here, the entire ICM sector on Solana was in euphoria. When it stopped, when it started to chop up, downtrend, the entire sector died with it. And even now, they rebranded to Believe, it's at zero. ICM and Solana is pretty dead right now. Another example of a larger and more recent rotation, on-chain coins on BNB. New leaders spawned, Aster right here went on a huge run to billions and ignited BNB meme coins into euphoria. And on that strong initial move up, the entire BNB sector was in euphoria. But eventually, Aster started to chop, lose momentum, CZ, the founder, started doing some dumb shit, and the entire sector started to lose that same momentum, which is where I'd say it's currently in now. Now, an important nuance to note is that sometimes the role of the leaders can rotate between coins, which doesn't mean that the sector is actually dead. Aster, which I just used, is a perfect example. This coin right here, 4, used to be the old leader of the BNB meme coin sector. Even though 4 nuked, all of the liquidity rotated into Aster, and the BNB meme coin sector still exploded with it. So be mindful of when this happens. The next indicator is volume and liquidity data. Works great in large sectors with lots of projects and exchanges. So this is essentially utilizing utilizing stats like volume to gauge the activity of a sector. Very easy to track statistically. In smaller niches though, data can be much easier to misinterpret or just straight up not exist. There's not going to be enough price data or liquidity for protocols to even support tracking like that. Next, and finally, is social sentiment. Obviously applicable in both large and more niche sectors. Everyone's always going to be talking about something. So you're looking at how individuals, so people on crypto Twitter, influencers, retail, etc., are reacting to that sector you're looking at. Now, this is definitely going to be more difficult with how much nuance and noise there is in the social scene of crypto, which I was literally just talking about. And obviously in broader sectors, there will be various individuals and Twitter communities you can track. And in more niche sectors, sentiment can shift much faster and louder with only a select few individuals or communities controlling that entire sector. And when you're reading social sentiment, when you're gauging what phase the current hot sector is in, and this might be a little bit controversial, is having the contrarian perspective in mind, especially during the euphoria phase. I'm not telling you to have the contrarian mindset. No, I'm just telling you to be aware of it. So for example, let's say you see a lot of people on the timeline flexing huge profits regarding a certain sector. Seems great to hop on, right? But if you think about this a little bit more closely, the euphoria stage is where the easiest money is made. So if people are capitalizing on the sector enough so that it's all over your feed, that might mean that the easy money has already been made, or that there's not much time left to make easy money within that sector. Of course, the time frame of how long euphoria will last depends on, once again, the size and scope of the sector. You know, a larger sector like AI meme coins can drag euphoria on for months, while a smaller sector like Solana ICM, which I was just talking about, can peak and die in a couple of days like you saw with Launchcoin. But just have this view in mind. And these are the only 4 indicators and the framework I use to determine where any sector is in the sector flow cycle. Anything besides these 4, you can just disregard as noise. Okay, so thanks, Alex. I now have a clearer picture of how money moves in and out of different coins in crypto, but how do we actually take advantage of this concept of sector flow that I just explained in order to find our edge and make money? So the fun part, right? Finding our profitable coins and beating everyone else. Well, it all comes down to how you play the cycle of sector flow. And there are 2 ways you can take advantage of this concept. Number 1, prediction. The concept of predicting what sector liquidity will flow to. So this is you asking, what coins should my eyes instantly go to when the sector first heats up? 2 completely different things, prediction and reaction. So let's first get into sector flow prediction. So what sector will money flow to? Now, prediction is obviously more difficult and less frequent as an opportunity. You are trying to predict a massive wave of liquidity concentrating into a single sector. But when it works, it's usually much more profitable than simply reacting to that wave. This is where these absolutely insane multiples you see on huge size come from. Now, it's easy to fantasize about being right and having the money to show for it, but how do we actually do that? To predict a sector flow, you can't just have a hunch and say, oh, I feel like this sector is up next. If that's how you're thinking about it, you are gambling. But if you're this far into the video, you know better than that, right? Instead, you need to actually build a thesis as to why money will flow into a sector. Actual structure is what will back your conviction. So let's break down what I call the anatomy of a flow prediction thesis. And right here, I've written down the 3 important steps you need to consider when making a thesis for trying to predict a sector rotation. Number 1, why is the sector priced where it is right now? This is the foundation of your thesis. Before you even think about predicting sector flow, you need to understand the current state of the sector you're thinking about. So ask yourself, why is it valued where it is? Do I have an actual understanding of the instrument I'm even talking about? For example, let's use Solana meme coins to BNB meme coins as an example. If Solana meme coins are underperforming BNB meme coins, so you're seeing a lot more coins on the migrated section of BNB. That could be because sentiment on Solana meme coins has exhausted for now, or maybe BNB meme coins simply have better infrastructure and more liquidity, or maybe all of these. My point is, if you don't understand the present, you cannot predict the future. Number 2, what catalyst am I betting on? Because liquidity doesn't just flow into a sector out of thin air, right? There has to be a reason for attention and capital to move into it. And catalysts usually fall into two categories. Number one, physical events. So a shiny new project launching, chain upgrades, big partnerships, regulatory approvals. And number two, sentiment events. So this could be a narrative gaining new hype, a meme going viral, a big influencer starts talking about it, mainstream news. And when you build your thesis, this second step is essentially you saying, I believe this specific event or shift in sentiment will bring money into this sector. But when you think of a catalyst for your sector, there's also another layer of nuance that you need to ask yourself. Who is my exit liquidity? So who is buying into this sector 3 times higher than where I'm buying? This could be, for example, retail is buying in after it's all over Twitter, or VCs who will chase after the sector after some project starts some new hype. My point is, you need to figure out if after the event happens, which specific audience will be willing to buy the coin way higher than it is now. And if you can envision a specific audience who will buy into the coins of your sector and pump your positions, the catalyst you're thinking of isn't the real catalyst. And the final point you need to consider when making a thesis is, what is my invalidation? The most important part of what makes a thesis isn't what's going to make you right, because anyone can write down reasons to be bullish, right? Anyone can pull anything out of their ass to convince themselves to buy into something. The difference between the gambling, blind sheep from an actual trader is knowing when exactly you were wrong. So when exactly is my idea invalid, and therefore I should cut my positions. And to build out your invalidation, you need to ask yourself, what are the counter catalysts that kill my thesis? You need to think in counter catalysts. This could be, number one, if your catalyst doesn't materialize in the time frame you expect, or something happens that directly cancels the catalyst I'm betting on. So something that makes the chance of whatever catalyst you were betting on happening 0. For example, I'm predicting that liquidity will flow into Solana AI meme coins because of the massive potential of this one AI meme coin. It's ran by a huge company and the developer is someone super stacked. Then all of a sudden, the developer publicly announces on his Twitter that he's leaving the crypto space because of some tech failure, or news comes out that he's filing for bankruptcy. Came up with a very easy to understand example here, but that's invalidation. And these 3 points in mind, without a crystal clear, well-structured, and thought out thesis, you are gambling. And that's what I see so many traders in crypto do. They say, oh, AI feels bullish, or memes are going to be hot, without actually knowing why, who's buying after them, or what would make them sell. Prediction only works when you have a thesis built out. So let's go over some case studies to help you with building your own. Sector flow prediction case study 1. Let's look at Solana and its meme coin market late 2023 to 2024 as an example of a higher time frame, large sector flow prediction thesis. And I say higher time frame and large because remember, we need to keep the scope and size of the sector we're analyzing when making these. Little bit wordy right there, but just bear with me. And attached, I've got the chart of Solana from 2023 to where it is now. So step number 1, why is the sector priced where it is right now? So why was Solana at $20 late 2023 and therefore with a dead meme coin market? So Solana recently dumped due to a black swan event of 2022, the FTX crash, and despite that, Solana's network was still running past the FUD, with improvements on stabilization being made regularly, which allowed it to hold its price of $20 even when so many altcoins out there were now just at complete zero. And with their network, they were the best in the game when it came to transaction fees and speed. Okay, so now we know why Solana dumped before and why it's holding up now. Step number 2, what catalyst am I betting on? So what will cause money to flow into Solana and concentrate into meme coins? So in this case study, anyone who was betting on Solana's meme coin market coming up, they were betting on overall conditions on crypto improving with increased institutional interest and implications of a crypto bull run, so favorable macro conditions. And in this case study, I'm betting Solana to be an Ethereum competitor, which still had the same congested and expensive fees it had during the last bull run. So not something any trader would want while trading a volatile sector like meme coins. And memes are always a leading sector of wealth during crypto bull runs, and Solana would be the ideal chain for them due to that inexpensive and fast infrastructure that I was talking about. Now, when I'm looking for a catalyst, I also need to figure out, okay, who is my exit liquidity? Who will buy Solana meme coins way higher than they currently are now? My exit liquidity would be the new retail investors of Solana who would prefer the low fees and high transaction speed over last cycle's main character, Ethereum, and then move on to meme coins because of the volatile, gambly upside that everyday people love. And historically, meme coins always gain traction one way or another during bull runs because it's where people throw their funds at after making money in the crypto market. So I'm betting that these people would be willing to expect the same returns I am, even at a higher price. And finally, what is my invalidation here? So what stops the Solana meme coin market from exploding? This could be if the chain of Solana itself starts experiencing the same network outages it had during 2021 and 2022, which was a big problem back then. Solana now proves that it's no longer a competitor and it would scare retail investors away. Another invalidation could be if another chain outperforms due to better funding and tools. So this could be an Ethereum layer 2 like Base, and that chain and its meme coins will take its place as the main competitor and retail investors will then turn there. And the final invalidation that I mentioned here could be institutions and VCs that are currently backing Solana, abandon it, and move on somewhere else for whatever reason. What happened in this case, as you all know, Solana meme coins ended up ripping and getting the retail attention that was being bet on in this scenario. Having a thesis like this gives you an idea on why you're actually going to be right, and therefore actually gives you the conviction to hold. Let's look at a more recent example and build out a prediction thesis for the recent explosion of BNB meme coins. So right here, we have the recent price action of BNB compared to Solana. So step number one, why was BNB starting to trend up compared to Sol in terms of market cap and on-chain volume? Well, Solana has been the main character sector for meme coins due to being first and positioning itself long enough with the best infrastructure to support them. And this deep into the bull cycle, other chains can't really compete, and when they do, it's only temporary with volume returning back to Solana. So we now know why Solana has been holding up this entire time. But narratives were starting to dry out. Losing traders were tired of just being exit liquidity for these same narratives over and over and over again. Meanwhile, on BNB, we started to see a new main character come up, CZ, the founder of BNB, and he's notorious for having an extreme amount of influence in the space and quote unquote criming up a lot of coins. And he was now actively speaking of a variety of incentives for BNB. So TLDR, new potential leading chain for utility coins and meme coins equals shiny new narratives and capital. Now, what catalyst am I betting on? That CZ will implement more incentives and promote coins, which he has shown to do in the past. And my exit liquidity in this scenario are on-chain traders FOMOing into BNB after a period of inactivity in Solana. But now, what are my invalidations for this case? So this could be catastrophic news around CZ, no coin promotions or incentives pushed during this BNB uptrend, so CZ not capitalizing on this, Solana announcing or actually releasing product upgrades that incentivize trading on their chain, or CZ implementing features that restrict rather than expose BNB to traders. And what happened to BNB? We saw this playing out. The entire chain exploded with multi-million dollar runners like Meme Rush, Palu, etc., which me and my students made hundreds of thousands to millions on. Pure euphoria. But then what happened? CZ started doing some bullshit. He started putting restrictions on American traders. People got tired of these same narratives on BNB playing over and over and over again. And CZ started getting shit from a lot of founders on the timeline from his previous negative incidents. And now volume on BNB meme coins isn't as hot as it was before. Now let's be real with ourselves for a second. Everything I just laid out looks really clean and obvious when you put it in hindsight, right? And it always will be. You know, it's so easy to look back and say, of course Liquidity moved to Solana meme coins. Of course BNB had that euphoria phase. But when you're in the moment, actually trying to figure out how to move, it's not so obvious. This is why predicting sector flows is so difficult yet profitable. You're gathering a bunch of confluences and catalysts in order to make an educated bet before the crowd even knows about it. Now, here's the part that most people miss. Prediction isn't just about making money. It's about training your brain and skill set to think independently from the rest of the crowd who are just blind gamblers. All of this is to train your brain and skill set to think independently. Every time you go through the process of building a prediction thesis, you are forcing yourself to study the current state of the sector, identify catalysts that others might be overlooking, think through why money would flow in, who your exit liquidity would be, and what would make you wrong. And that process is going to make you sharper and give you an advantage over other market participants. You are developing independent conviction and teaching yourself to see the market before it's obvious, and that skill compounds. The more you practice, the stronger your read on sector flow becomes. This is where you get your edge. Predicting sector flow, it's not just going to give you higher profit potential, it gives you self-conviction. When you've finally done your research and built your thesis, you're not going to panic when you see your entire timeline full of noise saying, oh, this is a rug, oh, we're gonna moon this. You know exactly why you're in the trade, and you know exactly what will make you cut. This is a skill set. And once you develop this habit of thinking forward, you will naturally find yourself positioning earlier, spotting rotations faster, and understanding the market on a level that most traders will never reach. And with that in mind, let's wrap up this section with a few final notes before we move on to the other half of executing on sector flow, which is reaction. First, remember that practice makes perfect. You are not going to get your edge right away, and nobody gets this skill right every time. I'm not perfect either. In fact, I will admit, sector flow prediction is probably one of my weaker edges, and it's something I'm always working on. You need to train it. If your thesis gets invalidated, don't just shrug it off and move on to the next. Dig into it and understand why you were wrong. Was it a bad read on sentiment? Did I overestimate how the catalyst would affect the sector? Did a counter catalyst I didn't even consider wipe me out? You need to take accountability. Personally, I journal and physically write down every step of my flow prediction process. My thesis, my catalyst, my invalidation, what happened and how I reacted. If you are doing this consistently, you will start seeing patterns in your own decision making, and that's what allows you to always improve. The same way a futures trader practice technical analysis through constant backtesting and actual screen time. Trading crypto and meme coins is the same exact way. If you want to find a profitable sector of coins, you need to practice flow prediction by constantly applying yourself. Also, don't isolate yourself. Share your thoughts with other traders and get feedback. Sometimes, and I'm guilty of this too, explaining your thesis to someone else exposes a lot of the holes that you didn't see. And when building out your thesis, an extremely important nuance and tip to consider that a lot of people overlook when considering the size of liquidity flows, so how significant the sector flow will be, is thinking about what sectors will bring new liquidity into the market. Very crucial tip I just brought up there. For example, when Solana caught attention on that initial run up in that first case study I used, it wasn't just from rotating capital from other sectors in crypto, right? It pulled in completely new people, retail, institutional money. That's what made that entire ecosystem explode. And a more smaller and specific niche example, ICM on Solana, I talked about this earlier, was the exact same. The concept of people being able to get funding for products from coins instead of relying on VCs and outside funds brought a shitload of developers and people who never touched crypto in their lives into the scene. And for that short period of time, ICM took up all the volume on chain, and we had Launchcoin running up to 300 million. Understanding the scale of liquidity flow into the sector you're betting on is crucial because it determines how long euphoria can last and how much upside is realistically on the table. If it's just recycled capital, sector flow might not be as significant. But if it's new liquidity, there's potential for some insane upside if you're right. But let me be very clear. The ultimate goal of understanding liquidity flow is not for you to copy me or anyone else. The goal is for you to develop your own ability to come up with personal theses and think for yourself. Remember, that's the core problem of people trying to trade crypto. And here's some confidence for you. If you've been paying attention and taking notes and you understand this concept, you are already ahead of 95% of crypto, probably more, 99 if anything, of crypto Twitter. Most people will never think in this structured way. So don't underestimate where you are right now, even just midway through this course, and where you could be in the future. So just give yourself a pat in the back right now. And just the fact that you're actually building this mental framework means you're smarter than most of the timeline. Congratulations. Now, you've finally seen your first window of your potential edge in the market. Sector flow prediction can be very powerful. That simple structure that I gave you and just running it over and over and over. And it can make you a shitload of money. But sometimes, no matter how good your prediction is, the market's not always going to cooperate with you, right? You can end up dealing with a lot of nuances, like catalysts taking longer than expected, counter catalysts popping out of nowhere, or maybe just a completely different sector stealing all of the attention overnight. That's where the other half of executing on sector flow comes in, because even if you don't predict money moving into a new sector, you can still capture a huge upside if you know what to do when it happens. The concept of sector flow reaction is you asking, how do I act when money moves into a sector? So to really picture how this works, the scenario, once again, a certain sector has received a massive hit of liquidity. Maybe you predicted it, maybe you didn't. The question now is, what do you do? Well, if you're early, you need to act ASAP. Why? Because being early to a sector liquidity flow creates some of the most profitable edges you will ever find in crypto. These are periods where 6 and 7 figure P&Ls on coins you've never heard of have been made in a matter of hours. So let's go back to the anatomy of sector flow. You know the cycle by now, right? Rotation, liquidity flows into a new sector, euphoria, everything inside the sector pumps, ceilings for new coins are in the stars high, fatigue, the sector gets oversaturated and the tension starts to spread thin and cooked. Liquidity drains, leaders nuke, new launches flop, and the sector dies out. You understand this by now. The stage we're going to be focusing on as traders who are trying to find an edge from reacting to sector flow is euphoria. This phase at the very top. Why euphoria? The early stage of euphoria is where liquidity and buy volume in a sector is at its peak. We can capitalize on this stage because this is where edge is created. Crypto is a hyper speculative market. When capital first floods into a sector, bullish speculation is set to the max, and new coins within that sector pump to insane levels, not because they're fundamentally good by any means, but simply because they're there first and riding on that ridiculous liquidity and buy volume of a sector in the euphoria stage. And what this does is create a temporary, quote unquote, risk off environment within that sector. The market doesn't care about risk. Nobody's doing proper research. Nobody can really gauge how valuable the narratives behind the coins are. Just that they are in a giga bullish, buy everything, bull market mentality for that sector. In layman's terms, this early stage is where people throw a shit ton of capital into plays that probably don't deserve it. So you can think of that initial stage of euphoria in a sector kind of as an easy mode market. Now here's where you find your edge. Generally, buying any sort of quote unquote established coin related to the cause of liquidity flow into a sector or tied to the sector will give you some insane profit potential. I'll explain what I mean by quote unquote established coins later on in the video and really dive into finding actual individual coins with potential later in the video. But for now, we're focusing on sectors, right? And I say quote unquote established for a reason because the term established can really be stretched in the euphoria stage, which I will explain with these case studies that will show you exactly what I mean by executing on sector flow reaction. So sector flow reaction case study 1. Let's take a real example and a sector flow reaction that I personally executed extremely well. A period where I profited sometimes hundreds of thousands in a matter of days. The explosion of AI coins in late 2024 as an example of sector flow reaction. So to help you understand this concept in the easiest way possible, I'll frame this in the cycle of sector flow. So phase 1. Rotation. We saw a massive liquidity inflow into the AI sector due to the popularity of the AI narrative within retail, new AI coins like GOAT right here running to hundreds of millions in market cap in days, which focused all of the attention of on-chain crypto to AI and speculative belief of applicable utility originating from crypto on-chain. Phase 2, euphoria. So coins like Fartcoin, AI16Z running to billions in market cap. And we also saw new, smaller, quote unquote, established AI coins running to multi-millions in seconds. But wait, let's stop right here for a second and dive deeper into what these smaller coins running to multi-millions in seconds were made of. And if you were around during this phase, you know exactly what I'm talking about. So might have caught you by surprise there when we're reacting. We're not trying to catch these huge billion-dollar runners, but these smaller multi-million-dollar coins. Okay, now back to what constituted a coin as quote-unquote established. So for an AI coin to run to over $1 million in market cap during euphoria of the AI sector, all it needed was some surface level credibility. This came down to a combination or specialization of a docs developer, so this could be someone with a face or name attached, somewhat working utility tied to the coin and white paper, a VC quote unquote association, and this could literally mean something as simple as a Twitter follow from someone with VC history, and a GitHub profile with any kind of developer history. That's it. Information you could find about the coin in literally seconds if you knew what you were looking for. And notice how these are all generally related to AI and therefore enough to get attention and label the coin as quote unquote established. And in this stage of euphoria, that's all an AI coin needed to run to millions instantly. So how was Edge formed? Looking at how new runners reacted and figuring out that formula alone gave you an advantage over everyone else who didn't know what the market liked. So an example, and my personal example, this is literally what I did, of how this Edge was actually executed on would be something like this. Number one, sitting on your trading terminal, waiting for new coins. So I'll use Axiom as an example here. Back then, Photon was the leading trading terminal, so I was using that. Just sitting on the trading terminal. Number two, stumbling on an AI coin, whether that was on this trading terminal, or if you were just sitting on Twitter or Dex Screener looking for new coins. So let's pretend this is some random AI coin that came up, mine. This is some random bullshit, obviously. I'm just using this as an example. Number three, I checked the Twitter of the AI coin and the followers and their following to see if they had a docs developer, if they had any post history, or any outside credentials linked to see if they were actually a real developer. So in this example, I'd open up the Twitter right here. This is linked to some influencer, so obviously it doesn't really apply, but I'd look through their followers, look through their following, see if there was a developer who showed his face and credentials anywhere there, or if I had any solid mutuals following the account. So this random account, let's just pretend this is a docs developer. Then I check if the developer had any prior success on any outside technical ventures or achievements. So I would see if there was a LinkedIn attached that I could look up. I'd Google them. I'd scroll through their Twitter to see any previous works. I'd look up their name on Twitter, and I'd see if they had a GitHub of the coin project and see if there was any comment history, if the developer had any stars, and if the coin passed this filter, I'd buy, and the majority of the time, the coin would run to multi-millions in a matter of a couple hours to a couple of seconds. A trading process that would literally take me seconds. It's just a few clicks on public information, right? The hard part is literally just sitting on the trading terminal or Twitter or Dex Screener and waiting for a coin that actually fits the filters. And if it fit the filter, I'd deem it quote unquote established and I'd buy. It sounds way too stupid and easy, but that's what the market is like in the stage of euphoria. The majority of coins that check the simple filter would indeed usually run to multi-millions in market cap easily because there was so much liquidity inflow into the AI sector. Being early and processing the right information on simple sites like Twitter and GitHub allowed coins that fit these loose filters to instantly run and offer the potential of some insane multiples. And during this AI sector euphoria phase, I'm talking back-to-back 5 and 6 figure days. Plays like these. I think I still even have one of these saved on the new PC that I got. This 200k PNL right here on video. So we've got a 19.4 ETH PNL on this coin. I can refresh, it's gonna be the same. Ooh. And a 36.8 ETH PNL on this Chrome profile that amounted to about $250,000. So you're just going to see me break this play down later on just because I think it's a really great example and it's a perfect execution of every single concept that I'm talking about throughout this entire guide. And these were just AI coins that passed this reactive filter that I talked about. Nothing special, yet these were some of the biggest PNLs of my entire career. I'm not gonna lie to you, I personally didn't catch some of the leaders during that AI sector flow. I did not catch leaders like Fartcoin early on the entire run up, which went to billions. Some of my research team did, but I individually didn't. But it didn't matter since I reacted to that sector flow perfectly and made up for missing those leaders by frequently catching smaller runners that rode off that liquidity injection. If there's anything I'm confident in, it's my edge as a reactive trader. And I know it might sound like I'm just trying to toot my own horn here. You know, oh my God, look at these plays and everything. But that's not the point here, right? I'm trying to emphasize the potential opportunity in reacting to this temporary window of euphoria. But let's go back to the cycle for now. So after that breakdown, we're now at phase 3, fatigue. You know, nothing lasts forever. And as more and more developers with backgrounds and VCs started spinning up AI coins, the market started to become oversaturated. And at this stage, coins needed much stronger backings, a more innovative utility, real VC ties to organically reach the same highs as the earlier weaker coins. All ceilings lowered and you started to see new launches struggle much harder to gain traction. I needed to be much more selective with the quote unquote established coin filter I just talked about. And finally, phase 4, the sector got cooked. You saw leaders like GOAT nosedive over 80% and the coins that would have instantly pumped during euphoria were now struggling to even gain buy volume, and most of these quote unquote established new launches would literally zero out within within an hour or less. This is a perfect anatomy of reacting to sector flow. If you caught the early euphoria stage and had the edge of reading what new coins shared in common and processed information faster than the crowd, you could capitalize on these absolutely ridiculous multiples. If you came late though, fatigue and cooked phases, you'd have a much more difficult time of finding profitable coins, or you just automatically get assumed as exit liquidity. And this concept of reaction applies to literally any cycle in euphoria. During ICM meta, I made 6 figures on the day Launchcoin ripped to 300 million without even catching the leader, because people were literally throwing money at any coin from the believed launchpad that had a developer, whether they were fake or not. I missed Launchcoin, but it didn't matter. I made up for it by catching those smaller multi-million-dollar runners. It was complete stupidity, and literally the day after, the market tightened. Coins needed an actual dev with history and a working product tied to the coin to go up. I went from making over 6 figures that first day to giving back some of my profits the second. Same thing with the more recent sector flow from Solana meme coins into BNB meme coins. I mean, I already explained what happened to the BNB sector before. Quick rundown, phase 1 rotation. After months of Solana dominating the meme sector, traders started noticing fatigue. New launches on Solana weren't hitting the same ceilings, volume was tapering off, and attention was looking for the next new thing, right? And at the same time, volume on BNB had already been heating up. And we saw a couple mid-tier runs hinting that, something was brewing, but the major spark was the launch of Aster. Aster ignited that rotation. It exploded in volume. It had an insane narrative. CZ was pushing this to heaven, and capital began to pour into BNB memes at a huge scale. And that's when we saw the euphoria phase. With Aster's run, the BNB meme coin sector entered full-blown euphoria. We saw new launches were insta-pumping, and coins that otherwise wouldn't stand a chance were flying to multi-million-dollar market caps. A single listing from Binance alone brought this coin Palu from 13.5 million to almost 120 million. Absolutely ridiculous. And I showed you how much me and my students made on this coin alone. What made a coin quote-unquote established during this phase? It was any connection to CZ, Binance's founder, whether it was direct references, memes tying the coin's narrative to him, or even vague associations. CZ was the main character of this sector. If your coin tied itself to him, it had credibility in the eyes of speculators. And Aster took its place as the leader, and we saw dozens of these smaller, CZ-linked coins. Some of the flimsiest memes instantly ran to multi-millions. This was the euphoria stage at its peak. Pure speculation, insane buy volume, and traders willing to throw money at anything that fit the narrative. And then we got into fatigue. Sentiment for BNB soured after Aster began to chop and lose momentum. CZ launched a new product that restricted US traders from trading certain coins on BNB, and CZ started getting into a lot of conflicts with many influential founders on the timeline, like founders from Coinbase. And the ceiling for a lot of new coins on BNB dropped. Launches that were hitting 5 million plus floors just days earlier were struggling to clear 1 mil. And yeah, traders were still engaged, but the liquidity didn't seem, infinite like before, and these sectors started showing signs of oversaturation. And eventually, Aster retraced hard, 4 continued nuking, and every new, CZ play was getting sold into immediately. Narrative became exhausted, and a lot of the liquidity rotated elsewhere. As you can see, most of the money on reaction is made in the initial phase of euphoria. This is when ceilings are the most loose and unestablished, which is exactly what you want during a bullish market. Everyone is extremely optimistic, buy volume everywhere, and mid coins can rip just because they exist inside that hot sector. If you're early, you don't need to be completely perfect. You just need to act decisively. Now, of course, you can't exactly predict how long that window is going to last by the exact second, but you can make an estimate by weighing in what we talked about in sector flow prediction through 3 indicators. Number 1, the strength of the catalyst. So the bigger and more clear the catalyst, the longer the stage of euphoria. For example, AI, which I talked about, massive narrative, and you could see its significance through coins like GOAT running to billions, change the entire on-chain and meme coin landscape for months. On the other hand, you have something like ICM on Solana, which I talked about as well, which you could best locate the euphoria period by looking at the run to 300 million right here. And sure, it was huge, made a big impact, but it was much more on and off and temporary compared to the months-long impact that AI made. Remember, trading these ICM coins on that run to 300 million on the second day was infinitely harder than the first. Number 2, ongoing sentiment. So when you're seeing posts of people hitting massive P&Ls on coins in a specific sector, that could be a
sign that the easy money has or is starting to pass. Now, of course, social sentiment should not just be, your sole indicator because of how much noise there's going to be on the timeline. And you should never just blindly listen to someone else's market advice without doing due diligence of your own. And when I'm talking about ongoing sentiment, remember that point I made about the contrarian view. Number 3, the strength of launches. So project launch quality. If you're starting to see quote unquote established new coins of a sector struggling to hit the same market cap that they could previously, that might be a sign that the euphoria phase is starting to pass, or that you might already be in the exhaustion phase and therefore be more risk averse with your capital. We saw this play out perfectly in the AI sector flow cycle. Coins with the exact same narrative were not hitting those $1 million market caps as easily as before. Like I said, there's not going to be a specific number you can calculate, but looking at these indicators can give you a very solid estimate as to how much time you have left during the easy money stage of sector reaction. Now, knowing that euphoria window exists alone gives you a massive advantage over everyone else in the market if you're acting with urgency. These periods are when you go balls to the wall and spend every hour trenching because you know that this is when ceilings are loose. And I gave you an example that I personally executed on during the AI coin sector flow cycle. But to actually find your own right now, the only way you can do that is by doing your own research and applying this baseline that I'm about to give you. So number 1, read the leaders on any sector right now to see where the sector is in the cycle. I used examples like Launchcoin on ICM, GOAT on AI. Number 2, size the sector. Remember, you need to keep the size and scope of the catalysts and how influential the sector is going to be in mind when you're analyzing it. Number 3, gauge whether it's in euphoria or not to get a picture of how easy the money is going to be for the day. And number 4, see how new coins are performing and what makes the ones that actually run. So finding those quote unquote established coins of the sector. Remember, the edge here isn't predicting the move towards the sector. It's in reacting when the sector goes euphoric. That moment a euphoria window opens, ceilings are out the window. If you act with urgency, I'm repeating this over and over again, but I really want to emphasize this. Urgency during that window before liquidity spreads thin, people get exhausted, you are making some of the easiest money in crypto. And there's a really good quote that encapsulates the idea of sector reaction from Howard Marks, the co-founder of Oaktree Capital and now has a $2.2 billion net worth. There are 3 ingredients for success: aggressiveness, timing, and skill. And if you have enough aggressiveness at the right time, you don't need that much skill. The key is in researching and finding out what is causing a coin to become quote unquote established during whatever sector you're trading right now. Whether that's Solana meme coins or BNB meme coins, you will have an advantage over other people in the market when it comes to finding good coins. Remember, the easy money is in initial euphoria, a very temporary window. By definition, reaction means you're playing a sector that has already received new liquidity, and once that passes, you're gonna have a much harder time. And sometimes, even if you are early, the reaction might not be significant enough to be worth playing. For example, if it's an extremely niche micro sector that received new liquidity because of a single leader, like we see a streaming coin meta happening on Solana because of one running streaming coin topping out at 3 million. If the leader is at a $3 million market cap and it's hard to see any other further upside, it just means that the sector straight up hasn't received that much liquidity. Now, the reaction is going to be new coins that spawn to maybe 100k tops and therefore might just not be worth your time playing. Great to analyze, sure, and I'm telling you right now to analyze and track even those micro flows, but there's just not much money to be made there on reaction. All right, let's zoom out and lock this in with some final notes. Obviously, same thing, every case study I used is in hindsight and used for analysis, but you can see they're not random stories, and instead, understanding them gives you an actual guideline and sort of a map that you can go off of. You're simply either A, doing research and building a thesis as to where you think money will move to next, or B, you're finding the short windows where money is easiest. By understanding how you want to trade and where you want to look, you are building the foundation for your edge, an advantage that you will have over other market participants. I know I'm repeating this, but that is my goal with not just this section of the course, but for everything I will ever talk about. I could have just given you the guideline for making a thesis or told you that money is easy when the market becomes hot. But now you actually know why and how you can capitalize on that. And after actually listening to my breakdown of sector flow, you also now know that sector flows are why the majority of your profits will only come from a handful of periods rather than complete consistency. If you're trying to predict a sector flow, for example, you now know know that there's always a cycle and that there's going to be a long period of time before a significant amount of liquidity rotates into a new sector. And if you're reacting off a sector flow, you now know that there's only a temporary window of initial euphoria where the trading will be the easiest. However, it is possible to catch these flows or react to these flows consistently, and that's where the true opportunity is in crypto. Therefore, patience and knowing when to sit on your hands is the most important trait of a trader who can read sector flows. And after you've just learned that you are not early to this bull cycle on a macro scale, you now know that you can be early in a different way. You can still be early to the next sector within crypto. Micro bull markets live inside every single cycle, and this concept of sector flow is timeless. This is a concept that you can apply to this bull cycle, the one after this one, and every single one in the future. It's in our biology as humans. We have human attention rotating because of an event or sentiment. Liquidity flows, leaders come up, euphoria, fatigue, cooked, new rotation. The characters and actors playing this can and will always change. For last cycle, it was NFTs. This time, it's meme coins. But the script stays the same every single time. But with constant opportunity comes another nuance. You now know that every opportunity in crypto is a ticking time bomb, and that your money is likely going to come from a handful of periods where you either read the flow or press it or both. So what does this mean for your edge? The advantage that you'll have over everyone in the market? Well, it means that your edge is always temporary in a specific sense. Edge is ever changing, or knowing the sector flow cycle and reacting quickly, but you're going to be working with different information every single time. You know, the new next hot sector is going to have different stats, a different team with different backings, and a different narrative. And the next quote unquote established coins of a new hot sector is going to be established and garner attention from traders in that sector for a different reason. They're going to have different similarities. Your edge is situational, created by this sector, this leader, this catalyst, this mood. The mechanics are the same, but the inputs are different. The AI sector ran because AI was the main character story. You know, GitHub signals, VC associations, surface level credibility like that were the right filters. And the Solana meme coin thesis worked because low fees plus a fast UX plus the culture pulled in retail. The right filters were simply virality and Solana being a perfect chain for memes. You know, no deep utility in the Solana prediction thesis case. Same framework, different data, right? New leaders, different catalysts, new tells, and what worked last month may not work next month. So build your process around adapting, not just memorizing. So this also means you need to take advantage of your edge while you still can and move on when it no longer works. For example, if you're a sector reactive trader, if you're able to figure out what makes a coin, quote unquote, established in a sector, like let's say AI coins are hot again, and you're able to figure out what makes new AI coins gain fast attention early on in the euphoric phase. So that exact initial moment AI coins get attention, you better be locked into the market all day and make as much money as you can, waiting for established coins to come up before the sector becomes exhausted. And when you realize that these new, quote unquote, established AI coins are getting super choppy, you're seeing way too many of them and some of them aren't even getting volume. So the bar for what makes a coin established is getting higher. Either get ready to sit on your hands a lot more or just move on and wait for the next euphoric phase of a new hot sector. And when you're building sector theses, remember, in smaller cryptos, invalidation is almost always narrative based, not price based. A single counter story, a rug, a leader nuking, a new main character coin is what's going to stop a sector from getting liquidity, not just because the price of that sector is fluctuating or going down. So remember to be patient until you actually see that invalidation. And the only exception to that would be when a price level is part of the narrative, right? A reclaim or all-time high that the story revolves around. So for example, I talked about Sapien earlier. This massive jump in price was from a Binance listing. And if you're making a thesis around Sapien, an invalidation could be if it breaks below the listing price, or if it breaks below the price it pumped to after it got listed, because then it could mean there's a third party creating much more sell pressure than you anticipated. I want to really emphasize this. This concept of price is almost always insignificant when you're trading crypto like this. You can't use TA or price action in most coins in crypto, where liquidity and price data is so much smaller than a lot of other equities and majors like Bitcoin, Ethereum, and Solana. So start looking at things in narratives, which I'll explain in the next section of Finding Good Coins. And when you're reacting to flow, don't just restrict yourself only to sectors that are already hot. It sounds a little contradictory from what I've been saying, that it changes the entire flow of liquidity. So leave room in your brain for for the outlier. For example, if you're sitting on Axiom on Solana, because dog meme coins on Solana are super hot right now, and you see an AI coin pop up on Axiom with an insane narrative and backing, and it's ripping crazy, don't ignore it, because that single coin going high enough could be the leader of a new massive wave of liquidity. So my point is, always be aware of outliers. And all this information I just gave you might be a little overwhelming, right? You're not going to get everything right away. So you also need to remember that practice makes perfect. Screen time is the most important aspect of mastering sector flows. If you're wrong or invalidated, figure out why and take accountability. For prediction, if your thesis is invalidated, don't just shrug it off and move on to the next. Dig into it and understand why you were wrong. Was it a bad read on sentiment? Did I overestimate how the catalyst would affect the sector? Did a counter catalyst I didn't consider wipe me out? Look into previous rotations and why they occurred. Why did ICM explode like it did? Was it because it introduced new liquidity on chain? Was there a revival of utility? And for reaction, look into what constituted good reactive coins in the past in previous sectors. I gave you some examples with AI, ICM, and BNB. Do they have any similarities? And if you were able to extract a lot of easy money during initial euphoria, and it's suddenly a lot harder the next day, write that down and maybe play more selectively. Find answers in the past and it will give you a clearer look into the future. Journal all of this physically, the thesis, catalyst, and validation, what happened, how I reacted, and share your thoughts with other people. Get more insights and more perspectives. These periods where the market looks down and there's not much activity going on are the perfect time to sit down and sharpen your sword. Understanding sector flow and how you're going to play it makes picking out individual coins and how you will size into them much easier. And if you understand the entirety of sector flow, the concept that money in crypto moves in a cycle, why it moves, and how to take advantage of this cycle, you have already learned how to think for yourself, and that will put you ahead of almost every other market participant out there. The people who are blindly waiting for their favorite influencer to call a coin only to get shocked when it's unprofitable and they don't even understand what happened. My students who took this seriously, who wrote things down, ran reps, and tracked their thoughts, they're the same ones who went from stuck in place to catching full sector cycles and flipping it into over sometimes 6-figure profits. So if you're doing the work, just know that this skill stacks. It's going to compound, and everything boils down to structure, feedback, and accountability. So the bottom line is that sector flow is a timeless concept. You can be late to the macro and still be early to the next rotation, this cycle and the next. Your job is to keep your edge fresh by reading leaders, sizing sectors, spotting rotation early, acting fast in euphoria, and cutting fast in fatigue. And when this muscle is strong, step 2 and step 3, picking individual coins and sizing them becomes 10 times easier. We will get there, but for now, I want you to master this. This is how you stop guessing what coins do well and actually filter the winners. The second pillar of finding a good coin, narrative analysis. So after you found the tide, sector flow, this is how you pick the boats. We know where and why the money is rotating. That gets us in the right lakes. Now it's about identifying which individual coins, the boats, will outperform inside that tide. But money is made on the boats you choose. And here's the rule I want you burned into your head. Every coin is a story, not a ticker. I want you to completely change your perspective about coins. At the core of every profitable coin is a compelling story that a lot of people can understand, repeat, and buy into. A combination of words, explanations, descriptions about the coin, and conclusions which all lead to the coin garnering attention and making investors buy under the belief that price is going to go higher. Put aside every technical fundamental you can think of, a coin's narrative is the most important aspect. Why? Because crypto, for the most part, still lacks mass real-world adoption. So how does the market price things? We price what could happen. Value is derived from the adoption that might arrive tomorrow, next week, or next cycle, which means prices get anchored to narratives, the story of what seems possible. Also, let's be honest, most market participants don't do research. They buy what sounds right on Twitter, Telegram, or TikTok, and the thread they read becomes their, quote unquote, fundamental research. That's exactly why narrative analysis works and why it's deceptively hard. If you want to buy the winners before the crowd, you have to think for yourself and actually do the work. So right now, I want you to change your perspective. Every coin you look at isn't simply just a coin, but a story. And a lot of the so-called educators in this space will tell you, oh, you can just scalp new coins all day. Look at traders like Cupsy. He's printing millions. Don't buy into that fantasy. Those coins on Axiom that just pop a few $1,000s in market cap and round trip to zero. Where do you think the liquidity for these highly skilled scalpers actually comes from? From people like you. That's the harsh reality. Most of the big names you've heard about who scalp successfully either have armies of copy traders feeding their entries, or they've been in the game long enough to make a career off less experienced traders being their exit liquidity. Trading is not some infinite money glitch. You're not here to spend your entire day looking at charts, scalping 50 different coins, praying for $100 scalp that you probably won't even hit. You're here to build generational wealth. And that comes from focusing on the highest quality stories inside hot sectors. And to best help you understand how to value these stories, I've created the 3 pillars of narrative analysis. So pillar 1, the story. Pillar 2, the storytellers, and pillar 3, capitalization, so timing and liquidity path. Memorize these 3. These are the filters I run on every single coin, every time. So let's break this down. So the first question you should be asking yourself when you're trying to value a coin's narrative is, what is the story? Not the contract, not the chart. What is the story that will make listeners believe that it will gain attention, that will attract new liquidity from the sector flow? It could be differentiation. Is it a new angle on a hot sector? Or is it just the 17th copy out there? So is it going to be a main driving story like AI, or is it going to be a consequence story like a segment of AI, like AI launch tools, an AI agent? The main difference is that a driving story is usually going to be the one that brings new liquidity into the market. You know, think the leading coins of AI, the leading coins of ICM, the leading meme coins. Now, that's not to say that you can't make money off of consequence coins, which can go to millions of market cap. I'm just saying that main driving stories are going to generate more attention. The next thing you can look at is memeability. I mean, meme coins were the main character of this cycle, and memes run on attention. So is the narrative something that's popular right now? Or is it something with the potential to become popular? Does it spread easily, and is it understood by the masses? And another point you need to consider when valuing this story is the cultural fit. How does the story resonate with the sector it's in? For example, we talked about AI coins exploding in late 2024. If AI is a hot topic, a coin with a narrative related to AI, like an AI agent that trades and does buybacks into the coin of the AI agent, is something that's going to get more attention if the sector, AI, is popular right now. So really think back to what I said about quote unquote established coins. This is really just me breaking that down into full depth. And I don't just want you to use these as like general points. A story doesn't just have to fall under a few select categories, right? The whole idea of analyzing a coin story is seeing if it has some kind of attention garnering engine, something that will garner attention and or established investor credibility. So you'll see exactly what I mean with some examples that I'll use to help you understand very soon. These are just some points that show you, okay, this is the story that the coin is telling. And that leads us into pillar 2, the storytellers. So credibility, capability, and distribution. The question here is, who is telling the story? So kind of think of it this way. If someone like Warren Buffett, you know, someone who's invested his way to billions of dollars, tells a story, people will listen, right? It doesn't matter if he's right or wrong. People will listen and his story will get attention. It's the same exact way for coins, especially for coins around utility. The storyteller can be just as important, if not more, than the story itself. But what makes a good storyteller? How can you tell whether the story, the coin that comes out of the storyteller's mouth will get attention? Well, you look at the storyteller's experiences. Someone with interesting experiences, experiences that have garnered the storyteller attention in the past, is going to have a story, a coin that gets attention. Experiences here, in the way I'm using it for this scenario, can be credibility, so proof of work, a docs developer, if they have, prior shipped product or a previous business exit or revenue that they generated in the past that established that there's someone who can generate attention and revenue. Capability, can they actually ship or maintain hype? So for example, every community on a coin needs someone who can regularly post updates and rally a community. And finally, distribution. So what kind of microphones do they have? Maybe they're connected to a VC or an institution or a crypto native community if they're an influencer or a larger significant platform. So do they have a way of distributing their story to a wider audience? And especially if you're a reactive trader, right? In early euphoria, and like I said before, that word quote unquote established stretches. And sometimes established just means, a first mover with a passable site, or it's a popular meme right now, where it has a decent narrative, a decent story. But if I'm putting real money at work, I want storytellers, developers, the team behind the coin to have real credibility and distribution. So when you're gauging storytellers, you're looking at the team, you're seeing if they have social proof, you're seeing if they have distribution, and if they have the ability to ship out whatever they're promising. Remember, the purpose of stories is to garner attention. The whole idea here is that the storyteller's credentials will gain attention itself outside of that story that's being told. Think back to that Warren Buffett example. Now, pillar 3 is capitalization. So the catalyst and the audience that the story is being sold to. So the question you're asking here is, when does this story actually convert into buys, and who is buying it higher? When you look at a coin's narrative, you need to figure out exactly what will happen that will make people buy 10 times higher. And then when it does go higher, what will make people buy 10 times higher than even that? So here you're looking at the catalyst. So what specific events force new eyes to show up, whether they're listings, partnerships, incentives, leader breakouts, campaign pushes, spreads of virality. Like I said, a physical or sentiment-based event that is going to bring in new investors and push price higher. The next thing you need to look at is the audience. So who is the next buyer? Who's your exit liquidity? This could be crypto Twitter degens, retail from social media like TikTok and Instagram, meme maxis, dog maxis, Ethereum maxis. It can be any group of people. The point here is just you need to know who is going to buy into this narrative when that catalyst hits. And you need to also ask yourself, when you're analyzing these catalysts, is it priced in? Did you discover this yourself, or did you read it in a viral thread yesterday? If it's everywhere, assume that this narrative is already priced in, or a lot of people are already expecting that same outcome, which means it's less likely to happen. And finally, you need to consider the probability and timeline of these catalysts. So what's the chance of this catalyst happening soon? If you're waiting 6 months, a year for a single catalyst to play out, you might need to reconsider it. So what you need to write in your notes when you're analyzing a coin for this third pillar would be near-term catalysts, the audience size and fit, the distribution channel to your audience, who buys your bags, 2 to 3 times higher, and what tells you that it's already priced in. And with these 3 pillars in mind, some examples of great past narratives would be like GOAT, which I talked about earlier. It was the first noteworthy introduction of AI coins on chain and AI tools developing on chain. It was a driving story that hinted that real applicable AI could arise on chain and that people actually cared about it. They were throwing millions, tens of millions of dollars into GOAT. It was backed by a Docs developer that had previous successful projects as well. Andy Aray, if you know him. And as the leader of the AI sector, there were countless possible catalysts for this coin that you could have thought of that were not priced in. So GOAT, before the AI sector blew up, is a perfect example of an AI coin with a strong narrative. Another great example are all the revenue meta coins that we've seen that have proven themselves as the winners of the cycle. Pump Fund coin, Hyperliquid coin, the official coin of Hyperliquid, which Axiom uses, a decentralized perps protocol, a protocol that generates the same revenue as Starbucks with 0.003% of the employees, with the Hyperliquid team buying back into their token over $1 million a day in order to help support the chart. All public information you can research. Backed by an insane team, the leader, Jeffy Yu, is one of the main characters of the cycle right now, and with so many different features that keep Hyperliquid's coin as stable as possible, with real earnings, staking, rev share, buybacks, their entire flywheel and tokenomics model. There's a reason Hyperliquid is one of the few true winning coins of this cycle. A literally only up chart ever since they launched. And the same exact thing for the recent run we saw on Bonkcoin. They implemented a similar tokenomics model to Hyperliquid and had a lot of the same benefits that I literally just listed. Pump Fund coin, another coin that pretty much ripped Hyperliquid's tokenomics model, has been holding up billions of dollars in market cap because of, once again, every single feature that I listed for Hyperliquid, real earnings and buybacks into the coin that garner attention and provide investor credibility. And even Launchcoin, which I keep using as an example, even though it's zero now, it had a very strong potential narrative, which you should know by now. It introduced the idea that founders could get funding for their products without outside help and simply through the blockchain. And notice how on every single one of those examples, they have a strong specialization or combination of an attention garnering engine, attention garnering storytellers, and potential catalysts for capitalization. Everything that creates a story that convinced investors that it would go higher without any actual adoption. Now, we need to glue all of those pillars into an actual thesis. This is going to look very similar to the sector flow prediction thesis framework, but this time we're applying it to a single individual coin with the sector it's in as context. Step 1, same thing. Why is it priced here right now? So what's the current perception? Why is it cheap or primed? Number 2, the catalyst. So which specific events will bring buyers in? And with the catalyst, you also need to ask, who is your exit liquidity? So who buys it higher and through which channel or narrative? And number 4, invalidation. So what kills the story and exactly what makes me cut? If I can't fill these 4 boxes fluently on any coin that I'm looking at, I don't buy it. And let me show you how me and my students applied this thesis framework in some real trades. So case studies. Number 1, video coin by Dracula. I talked about this earlier. This was a perfect execution of narrative analysis that I made, and as a result, I made $250,000 by executing my thesis. So here's how I framed it. Step 1. Why was video priced here right now? So why did I think video was a good narrative? I saw this coin at under a $100,000 market cap. You can see my initial buys right here at an average price of about 94K on Dex Screener on the base chain while the AI coin sector was in euphoria. I opened up the chart for video coin by Dracula, and as you can see, you can't just use the chart and price for this step. It tells you nothing about the story. So I did some research. I opened up the Twitter for Dracula. The Twitter it was connected to, massive page, and the first thing I did was check their following and followers, a lot of mutuals right here. And what I noticed in that paradigm, if I scroll down, they followed them back. And if you don't know who Paradigm are, they're one of the most influential crypto institutions in the space. They're behind some absolutely massive projects like Blur and Magic Eden, which have raised and done hundreds of millions of dollars with coins reaching hundreds of millions of dollars. And after scrolling on Dracula's page, I noticed that Dracula also had an official app, and in one of their past tweets hinted that video coin by Dracula was going to be the official coin and have a real use case for the app that they were developing. So we have an AI coin during euphoria that was going to have real utility for an app that Dracula was developing and hinting at for a long time. I mean, they have tens of thousands of followers and are followed by very influential mutuals, and they were possibly backed by a crypto institution that was behind protocols that have generated hundreds of millions of dollars. This was something that would draw attention and investors, even for a coin with this low of a market cap at the time. I mean, my $1,000 buys were pumping it by tens of thousands of dollars in market cap. I was getting fucked by price impact, and for these coins in base, the developer can add or remove liquidity. So with this information, after doing research in mind, the reason that it was priced this low was because there was not enough exposure, so not enough people knew about the potential backings, and it didn't have much liquidity at the time, which also told me that the Dracula team was still working on this coin. Okay, we know why video is priced like this now. Now let's go into step 2, the catalysts. What specific event would bring buyers in? As I broke down, the main reasons it was this low was because of exposure and the team not adding enough liquidity into the coin. So the catalysts are very clear in this case. The Dracula team adding more liquidity and influential figures in the crypto space finding about the coin and letting their audience know about the coin's credentials, which I broke down in the step right before. My exit liquidity in this scenario are on-chain traders once the coin gains more exposure and investors of Dracula and their app buying into the coin. And step 3, the invalidation, obviously very clear again, would be Dracula disassociating with the coin. So the main one would be Dracula confirming that video coin would not have any utility for their app. Announcements like those. Full narrative analysis rundown right there, and what happened? My story played out exactly how I predicted it to, and I ended up making 19.4 ETH on this wallet and 36.8 ETH on this wallet. Over $200,000 while I was still taking classes at Cornell. I remember I was literally in my diversity class at 9 a.m. in the morning and selling $10,000 clips in the back of my classroom and not remembering a single word of that lecture because I was trying to not just scream in the middle of class. Let's move on into the next case study. Clanker, a coin that pumped very recently from 20 mil to 140 mil. This was another very recent
perfect execution of narrative analysis. A 22-year-old named Kevin who goes to Georgia Tech, he goes by Kai on Twitter and Discord, made on this coin Clanker, and as a result, made 500k individually, with my entire circle making a total of about $3.4 million. It's still holding up extremely well right now, so let's break the narrative down and how we analyzed it. So step 1, why was it priced at the point pre-pump? So this range, a member of my research team, Shams, saw Clanker at a $31.7 million market cap. You can see the first scan right here. It stumbled on his curated feed, and after doing some research on their Twitter, we saw that they were one of the leading launch pads on Base and doing millions of dollars in revenue. And as I explained before, this sector of coins with protocols centered around revenue have been in euphoria pretty much the entire cycle. Coins like Hyperliquid, Bonk, Pump Fund that have hit billions of dollars in market cap. And as one of the leading launch pads on Base, the team had a large amount of influence in the crypto space. They had employees in Coinbase, nothing else to note about there. This was something that would definitely draw attention and investors. However, they did not have buybacks yet implemented. They were lacking a lot of the features and tokenomics models that revenue-based protocols like Hyperliquid implemented. Features that the team was hinting at for a long time now, but still hadn't executed on. And like I said, the coin was already up quite a bit since launch. I mean, we saw it sitting at a $30 million market cap. So with this information after doing research in mind, it was clear that the reason that it was priced at this point was because they did already have exposure, credibility, and everything, but no real spike in price at this stage because of a lack of catalysts. The team was all talk, no action at that price point, which leads us into step 2, the catalysts. What specific events would bring buyers in? So the catalyst, once again, should be very clear in this case. The team implementing buybacks, revenue share for holders of the coin, any features or use cases for Clanker, lots of scenarios for one of the leading launch pads on Base, and a revenue-centered protocol. I mean, almost every single big running coin on Base was launched on Clanker. My exit liquidity in this scenario are Base maxis and general on-chain traders if the team actually delivers, with hopes that these investors would see Clanker as incredibly undervalued after proper revenue-centered protocol features are implemented, especially with sentiment on chains like Solana lowering by the month. People were getting tired of coins on Solana. And step 3 should also be very clear. The invalidation would be the Clanker team just not delivering within an appropriate time frame, or another launch pad on Base taking over with just as stacked of a team and delivering proper features of a revenue-based protocol like buybacks, revenue share, and other features. Full narrative analysis right there. And what happened? Very recently, months after this analysis, my student Kevin noticed that an unknown wallet picked up $400,000 of Clanker and realized that something was potentially going on, because Base coins usually have this type of price action, just massive buys out of nowhere with no public catalysts right before huge news. And right after, Farcaster, one of the leading protocols in this entire space, Farcaster's founder Dan Romero is the vice president of Coinbase, acquired Clanker and they implemented buybacks and a flywheel. Boom. $3.4 million play for me and my students from simply analyzing the narrative on Clanker. $3.4 million on a single coin, even though it took 6 months for this narrative to play out, all from a structured thesis. And with these examples in mind, you should by now realize the truth, that most coins are trash and have no reason to outperform. I mean, stop for a second and look at Pulse on Axiom right now, and I can almost guarantee these coins on the migrated section don't even compare to those 2 simple examples I just broke down. No story, no storytellers, no path for new buyers. Like, go to this coin right here, for example. Username. Explain your username. What the fuck is this? No story that will garner attention or establish credibility from a wide audience, ran by an anonymous nobody, and no realistic chance of any kind of significant event that will bring new buyers in. There's not even a current hot sector that this fits into. The social media engagement sector, the virality meme coin sector. Explain your username from Ships. Anyone buying into this is either an influencer with copy traders or an idiot. These coins exist to grind liquidity and pay influencers. If you apply the 3 pillars and your 4-box template, you will disqualify 99 99% of the market instantly, and that's good. Your P&L is the sum of the bad trades you don't take, and after learning about narrative analysis, you should instantly be way more selective of what you buy. With this framework in hand, there is no reason your capital should be touching coins like this with a 10-foot stick. Yet I still see so many traders trying to capitalize or scalp these terrible risk to reward, quote unquote, opportunities like these, only for them to rug and fly straight to zero when you could have just applied this principle and avoided that stress altogether. Don't give in to price indicators like volume. Look at the coin's narrative. Now, once again, I mentioned this in the final notes of Sector Flow. Remember, in crypto, invalidation is most often narrative based, not price based. Price is the effect. The story breaking is the cause. So this could be the leader in the sector nukes, or it loses its narrative. The catalyst of the coin you're looking at gets canceled or delayed beyond your window, or another coin steals the same story with better storytellers, or liquidity rotates to a new sector and doesn't come back to the one your coin is in within your time frame. If any of these hit, I cut. I'm not married to the coin, only to my thesis on its narrative. So after everything I just broke down, you can see that being good at narrative analysis gives you a window of advantage, an edge. You are seeing the story before the crowd and knowing exactly who buys it higher. Now, what exactly does edge mean here? Well, your advantage in narrative analysis is the repeatable ability to, number one, underwrite a coin story, pillars 1 to 3, before it's obvious. Number two, rank that story against other coins within the sector with similar narratives. And number three, act with conviction because your thesis is already written down. Your catalyst, your exit liquidity, your exit path, it's all written down. And when you can do these three things consistently, you stop guessing. You will know which boats inside a hot sector can actually outrun the tide, the established coins. Now, this is deceptively extremely difficult. You know, everyone thinks they can spot good narratives, but most can't. Narratives evolve fast. Same thing when you're predicting sector flows. What garnered attention and investors last month may no longer look so appealing this month. Noise can mask itself as research. You know, the viral threads you're seeing might look like an eye-opening thesis, but because they're online and public, everyone can see them, they might already be priced in. And you can also deal with biases. They can bite you in the ass. If you've made a lot of money during the AI meme coin cycle, you might overvalue utility and clever tech and undervalue simple memes that can spread easily. And you'll also deal with partial information. You're not going to always have all the facts on the team behind the coin, their distribution, or the timing on catalysts. And speaking of timing, you also deal with timing risks. You know, a great story in the wrong phase, if you're seeing a solid ICM coin when the ICM sector is cooked, you could still lose. And if you're serious about learning how to actually spot these narratives early and not just guess, that's exactly what we're working on inside the mentorship. It's already taken people like Kevin from just starting out not even half a year ago to applying these proven systems and made me and my students and Kevin a collective of over $3 million on a single play. Students like Bowen, a 20-year-old with a similar story who has been in this game for not even a year and has recently just hit his first six-figure play with us. Now, with all those challenges of finding a good narrative, what is the solution? Well, you're going to need time and experience in this market. Yeah, it sounds generic, but that's not a cop-out, okay? It's genuinely all you need. Your job isn't to be perfect. It's just to be around long enough to see what narratives, what news, what events crypto actually likes and resonates with and what it doesn't. So how can you actually build this skill? By putting in the screen time. Look at what did well in the past as your homework right after you finish this course. Number one, build a narratives almanac. This is a doc or note section that you are going to be constantly updating with every hot narrative that you see. Go look at previous sectors that exploded in the past. AI, animal meme coins, news coins, stock coins, ICM coins, revenue model coins. And for each one of these, list the top 5 winners this cycle with a description of their story, the catalyst that pumped them, the audience that bought it higher, and any invalidations that they triggered. This is how you become someone who can analyze narratives and recognize patterns. By doing your homework and looking at the history, the edge in narrative analysis is always going to be in pattern recognition. And number 2, the 15-second story test. I want you to do this 5 times every single day. Go on Axiom. Right here, look at the poll section, pick any live coin out and say out loud, this
is a meme, utility, or culture coin about blank, their story in this sector phase, and the catalyst X brings audience Y who buy it toward a coin with a similar narrative. This will, once again, train your pattern recognition in terms of actual execution. Do these reps and look at the past, and your narrative analysis will improve so fast. Practice is the only way through this deceptive difficulty, and eventually you will reach a state where you can literally open up your trading terminal, take one glance, and see if any of the coins have narratives with any potential. Now, when you are implementing narrative analysis into your trading, you will see coins go vertical, absolutely parabolic with no coherent story. Trading these is not edge, that is roulette. If I can't understand and research the story of the coin I'm looking at, I pass it completely. Sticking to narratives I can underwrite is why I keep my gains, while timeline gamblers just give them back later on. There are always good wins and there are bad wins. A good win is a trade you actually planned out, understood, and actually built a thesis around to give you conviction. A bad win is a trade you're entering on a whim. It doesn't matter if you made money on a bad win. Bad wins are going to reinforce bad habits, and those habits will make you lose more money than you won in the long run. Same thing with good losses. As long as you implemented those three pillars, you stuck to your structured thesis, you will come out on top in the end. It's all just about staying disciplined. Now for some final notes to wrap up the second pillar of finding good coins, narrative analysis. Okay, so most coins are trash. No story, no storytellers, no path. You can disqualify 99% of coins so quickly through this concept so you can spend time on the 1% that matter. Your P&L, remember, is the sum of bad trades that you don't take. And a lot of the times, simple beats clever. You know, the market often rewards familiar, easy to understand stories with clear reasons for why investors would buy even higher over complex narratives that very few people can explain. Don't try to fight human nature. And remember, the storyteller matter. In early euphoria, for example, quote unquote established can just mean a first mover with a decent storyteller, a somewhat capable developer. Later on, it means real proof of work or concept, so you need to adjust your standards by phase, and timing is part of the story. A+ narratives can lose you money in fatigue or cooked phases. Narrative quality does not always equal a buy signal without keeping sector flow in mind. And to add, remember, a coin's narrative doesn't have to align with the current sector for it to be a strong one. I went over this when I talked about outliers in sector flow. Sometimes a single coin's narrative is so strong that it causes an entirely new sector flow cycle to occur, so be aware of everything. And when you're looking at coins, please do not just look at price and volume. Price is the effect, story is the cause. Your invalidations will be narrative first, whether it's a counter catalyst, a stronger competitor coming up, a leader dying, liquidity rotating out, with price and time kind of just as that enforcement line. And the only way you're going to get better at all this is by documenting. If you didn't document it, you didn't take the trade. Write your theses, your catalysts, your invalidations, the outcome, the lesson you learned from taking the trade every single time you make one. Today's notes are tomorrow's convictions, and stay in your lane. Be disciplined. You will see coins just go only up with no coherent story. If you can't understand it, just let it go. It's not your trade. The bottom line is that your edge of narrative analysis is earned by studying what ran, scoring live stories against those patterns, and writing the path before you enter. It's not going to be flashy. It's not an easy process. This is something that a lot of traders can never understand for their entire lives, but it's how you stop being exit liquidity and start choosing the boats that actually deserve your capital.
Before we move on to the next step to finding good coins, let me leave you off with a question. So 2 coins launch on the same day in the same exact sector. One rips to a $50 million peak while the other stalls at $1 million and dies. Now, why does this happen? Well, if your first answer is liquidity, you're close, but not all the way there. The real difference is the story that the market can understand, tell, and buy into. In the next step of finding a good coin, narrative analysis, I'm going to show you exactly how to separate these two outcomes in advance. We're going to build a simple scorecard around these 3 pillars. Number 1, the story. Number 2, the storytellers. And number 3, the timing and exit path, so you can properly grade any coin and figure out if it's worth your capital. We're going to run it on real examples, and I'll give you the exact thesis template I use to find individual coins with potential.
Risk to reward, so actually pricing the story of your coin, sizing your position, and planning your exit. Now, What is risk to reward in our context of trading and investing in crypto? Well, risk to reward is not just some piece of advice here, it's the math and actual execution of your edge when trading on chain. Risk to reward equals the conservative, evidence-backed upside over the distance to invalidation. So you've already learned to define invalidation, when to cut your position, and your theses when analyzing sector flow and narrative analysis. But what we haven't done is actually planning out our entries and scaling out of our positions. This is where we do it. Step 3 is where we combine steps 1 and step 2 and actually execute steps 1 and step 2. We take what sector flow tells us about the window and what narrative analysis tells us about the coin, then we turn both into price targets, position size, and exit rules you can actually follow. Now, before we even dive in, let's start with 3 questions you should always keep in mind before buying into any trade. Say this out loud with me, okay? Number 1, where can this story reasonably price after my catalyst? Number 2, what's the chance a counter catalyst hits before that? And number 3, given both, is the payoff worth the wait? Every time I ignored these 3 questions and told myself, oh, I'll just go in and see what happens, I lost money in the long term, even when I looked into the coin's narrative. On the flip side, every time I wrote them down before I actually executed any significant moves, even my losses became more structured and actual learning lessons because I had this framework in my mind instead of just relying on my emotions. So the third pillar of finding good coins, risk to reward, is basically just the execution of steps 1 and 2. Think of risk to reward like a small fleet in the different lakes of crypto. So step number 1, sector flow, when the ocean tide is rising, where and which lakes the ocean is flowing to, and how long these flows might last. Step number 2, narrative analysis, so which boats you should pick to ride the tide. And step number 3, risk to reward, how much fuel you give each boat, where you'll land, and when you abandon ship. So we've been going top down so far, right? And this is where we take all the concepts we learned and go from thesis to actual execution. So understanding concepts and turning that into money in our portfolio. The fun part, guys. And everything we do now is set into 3 layers. Layer 1, sector context from step 1, how far ceilings can stretch and how long the window might last. Step 2, narrative quality, so who will buy it higher and how fast attention can compound. And step 3, price and structure. This is where the inefficiency is and how you will size, enter, and exit. And with these 3 concepts in mind, the alpha, the money you're going to make from the trade, lives in the gap between today's price and what this story should be worth in this sector, this phase, with these catalysts. Of course, by now you should know how much I hate blanket statements, so this isn't something we can value exactly, but we can get the best estimate for that gap in 3 ways. Number 1, the peer comps ladder. So you're comparing the market cap of the coin you're looking at to possible or previous competitors and asking, if the narrative of the coin catches fire, what's the first bear valuation I can place on this coin after my catalyst lands? The idea of the peer comps ladder strategy, really boiled down, is simply just comparing the valuation of the coin you're looking at to valuations of coins in the past with similar narratives. You're building a ladder, a process of comparing valuations. And most of the time, that's going to look something like this. Number 1, figuring out the sector of the coin you're looking at. Number 2, finding out coins in that same sector with similar narratives. Number 3, recording how the previous similar coins reacted to catalysts, and gauging how strong the catalysts for the previous coins were compared to the ones you're looking at right now. And number 4, backtracking everything with the sector cycle in mind. And this last step, number 4, is a super important nuance to consider. For example, the previous coin with a similar narrative in the past could have exploded after a catalyst occurred because the sector that coin was in was super hot at the time. If the sector the coin is in now isn't doing as hot, the catalyst likely isn't going to have that same reaction. And a really good example for me to demonstrate to you is this coin SBET right here, which me and my students made about, $351,000 on. So real quick rundown, SBET is a stock coin of SharpLink Gaming on the Ethereum chain. It was made out of the news of SharpLink Gaming, a NASDAQ listed company, buying billions of dollars of Ethereum, which resulted in people on the blockchain making a coin for it. And real quick rundown of how powerful this narrative is. People on crypto really love coins on memeable stocks related to crypto. And we saw SBET at about a $161,000 market cap, all the way at the bottom right here, when news about SharpLink Gaming publicly buying a shitload of Ethereum came out. Now back to what I was saying about individuals in crypto loving stock coins, really good narrative. Some very general coins with similar narratives were coins like GameStop, GME, which went to an all-time high of about 221 million. I scanned it right here, and a variety of other quote-unquote stock coins made from impactful financial news on meme stocks or crypto stocks went to millions of dollars in market cap. And news about a NASDAQ listed stock positioning themselves as the next MicroStrategy of Ethereum is very impactful news. And the best way we can kind of build this ladder, value this coin to other previous similar narratives in the past, is by simply looking at how well these stock coins have done in the past. And I gave an example right here with GME going to hundreds of millions of dollars. However, GME ran this hard when the stock coin sector was in euphoria, and it was the sector leader of the stock coin sector during that time. So we cannot align SBET coin to the 221 million all-time high of GME. But how we were able to capitalize so much on it and knew that it was undervalued and at this original price point of around 100k market cap was by having this perspective of how well stock coins on impactful news of these kinds of stocks have performed in the past. So a little wordy right there, but the bottom line of this pure comps ladder is you're trying to keep the sector cycle of the coin you're looking at in mind. So if the market caps you're looking at were coming up during early euphoria and you're currently in mid fatigue or cook stage of the coins, you want to lower your expectations. And the reverse is also true. If coins in the past were still performing okay, but the coin you're looking at now is in euphoria, upgrade your expectations. So the idea of finding that story price gap here would simply go something like this. Okay, you're looking at the coin at a 161k market cap on huge financial news of a crypto stock, and coins centered around financial news like this have gone to hundreds of millions in the past, but that was when the market favored stock coins more, and that was a sector leader. So instead of expecting this coin to run to hundreds of millions, we can expect it to maybe go to a couple million. And what happened? It went to an all-time high of about 14 million in market cap. So this is the first window of that story price gap we're trying to find. Really boiled down, SBET was undervalued at 161k because of what similar coins like this have shown to do in the past. Number two is going to be the leader multiple method. So the basic premise here is figuring out the coin sector leader as a starting point for valuations and establishing that in extremely optimistic, euphoric phases of the sector flow, the coins with the strongest narratives in a sector will usually be 5 to 20% of the sector leader. And this percentage drops heavily the further we get into the sector cycle and the weaker the coin's narrative is. So how do we actually do this? Number one, we verify the leader of the sector. So the coin with the highest sustained circulating market cap and strongest narrative in a sector. Let's actually run this through an example. And if you're a little bit confused with what I'm saying, very boiled down, it's just that the coins with strong narratives in a sector will usually be valued at 5 to 20% of the sector leader, the highest market cap coin in the sector during hot market conditions. So how do we actually do this? Well, number one, we have to verify the leader, the coin with the highest sustained circulating market cap and strongest narrative in a sector. So real quick, Clanker, okay? I used this as an example before, one of the sector leaders of the base launch pad at the moment, and the sector leader for any coin that's launched under Clanker. Number two, we verify how in line the narrative of the coin is with the sector and its leader. So for example, let's say an AI agent coin comes out centered around scanning for good coins on the Clanker ecosystem. And they have a very strong backing. You know, some of the mutuals on Clanker are officially supporting that trading agent, and it's technology that users who are trading on the Clanker ecosystem are actually using. That is a coin with a narrative that is very in line with its sector. And finally, we need to compare the circulating market cap with the leader. So if the sector leader is at right here a $70 million market cap with an all-time high of $140 million market cap, expecting a 5 to 20% valuation of that trading agent coin, if it has everything I just listed, you know, stacked team, the tech actually works, people are using it, a 5 to 20% valuation is completely realistic. Now, it's also important to mention that you're never going to be able to value an exact percentage, right? That 5 to 20% valuation that I gave is arbitrary, and that as the sector goes deeper into its cycle, the cloudier that 5 to 20% will be. So there are some nuances to keep in mind, and this process is extremely dependent on your narrative analysis. And finally, we have the catalyst path valuation. So mapping the next dated believable catalyst and pricing the coin at the first node up that catalyst should unlock. So estimating the value of the coin after it triggers that first believable catalyst. So how we're going to do this is by actually building up that path, right, for the coin. So you want to list the next 2 to 3 catalysts of the coin with dates and windows. So let's use an animal meme coin on an animal that's currently going viral right now as an example, okay? So let me just write this down, animal meme coin catalyst path. Okay, so the initial starting point would be the animal meme is still picking up traction on social media. Then the first realistic catalyst could be, okay, it reaches CT and it resonates well with crypto Twitter. Then the next catalyst could be KOLs talking about it. Then larger KOLs talk about it as it picks up. Then final stage, retail from social media find out about the coin and buy in out of culture or to support the animal. Obviously, I generalized a little bit here, but you get the idea. Another example for, a technical or utility-centered coin could be, okay, we have the utility coin catalyst path. So the starting point would be coin that the product is centered around. Then the first catalyst could be a product upgrade of some sort, then a partnership, then a listing, then further ecosystem development. Once again, very generalized here, but I'm just trying to make this easy to understand for you. And for this first step of catalyst path valuation, we're just mapping out the catalyst for any potential coins, right? And the next thing we want to do is attach a comp to each node. For the first example, the animal meme coin catalyst path. After CT picked up the animal coin and resonated well with it, the similar animal coins in the past tagged XYZ. Went from, well, in this case, it would be from X to Y. And after this KOL who likes these kinds of animal meme coins talked about it, it hit Z. And then we want to use these nodes as base targets. The idea of catalyst path valuation is going step by step for each catalyst. We don't want to go all the way from just animal meme is still picking up traction on social media to retail from social media finding about the coin. There's a lot of different catalyst paths that are more realistic of happening before it goes into the end game. So we don't want to price this fantasy. So after doing this, you should very clearly understand what I'm trying to say by price story gap right here. These are the adoptions that could happen and give these stories, these coins value. And I want you to really keep these base targets in mind, the most realistic catalysts. So once we have a better idea of this kind of gap, we need to actually quantify the reward. So we've entered the coin right here because we see this kind of gap in valuation and what will bring investors into the coin. Now we're painting a clearer picture on how to execute on them. And for this step, I want you to keep this worksheet in mind to just make everything super easy. So first thing you should look at when you look at a coin, the sector it's in and the phase of that current sector. Then the coin's actual market cap, then the peer comps, so coins with similar narratives and how they've performed. You're just comparing market caps. And next, the sector leaders' ceilings for further comparison. And then the next realistic catalyst that you're betting on and a loose time frame of that catalyst for triggering. Then the base target after that catalyst hitting. Remember that base target is the first fair comp after the next catalyst. In the utility coin example, it would be the first product upgrade, or even better explained with a real example, Clanker, the product upgrade would be the implementation of the flywheel, which happened to get paired up with a partnership. And you also want to ask yourself what the stretch target is. So potential catalysts that could occur if you zoom out. In this scenario, for the utility coin path, it could be listing on a CX or a partnership with a big institution or group. And of course, with these base and stretch targets, the time risk, once again, the loose expectation, the window you expect for these base and stretch targets to happen. And finally, the invalidations, either the counter catalysts, the price invalidations if they're a key zone, or the potential of liquidity rotating out due to a better competitor. A good example of this worksheet being put to use would be, let's say, I'm looking at a coin and using the price of the coin sector leader and coins with similar narratives as a perspective. My starting point is X. I will value my base target at Y and stretch at Z only if this catalyst happens, and I am out if this invalidation hits before we hit stretch. If you can understand what I just said there, you're getting better at pricing these coins. But some very common traps you want to keep in mind is using last month's euphoria comps in today's fatigue. Be aware of sector cycles and how they affect individual coins. I showed you with SBET. GME coin hit a $221 million market cap only when the stock coin sector was going euphoric. I cannot use this $221 million as the ideal point for a coin like SBET, simply because the market doesn't favor it as much. Another common trap is pricing that fantasy node immediately. When I'm measuring that gap between the coin's current price and what could happen, its catalysts, I'm not going to be measuring the utility coin from, let's say, where it is now all the way to a listing on a CX or ecosystem development. You don't want to get lost in the sauce. And finally, you don't want to fall for priced in catalysts. If it's viral or news that already exists, you're probably already too late, and or you should discount it heavily. If you found out about the Clanker partnership with Farcaster and implementation of buybacks days after it happened, that catalyst has already triggered. You cannot build a catalyst path off of that. And when you're exiting your position on these coins, with this worksheet in mind, with everything I talked about in mind, you should not be doing any arbitrary sell initials at 2x nonsense, right? Your exits should be anchored to catalysts. Your base targets, the first fair valuation after your catalyst. Your stretch target, where it could reach if the sector stays strong and a second catalyst lines up. Your moon target, if there's a hard dated event that could re-rate the entire story. And as a side note, most of your trades will not have a moon target, but you should be exiting based off of these. Your catalyst path. An example of this could be like scaling into the starting point, and as the first base catalyst happens, exiting some of your position on strength and keeping a large portion of your position in the coin as long as the sector leader holds their trend and your next catalyst is clear, and then exiting most of your position on the stretch target and continuing to exit once counter catalysts become clearer. This could be the sector looking more exhausted, the leader looking like it's breaking down, no more realistic catalysts in sight, and cutting your position at any point when a counter catalyst actually occurs. For my video coin example that I used, I did not sell this entire time on the way up, even from my entry at 94k, just because price was fluctuating. No, I sold when my catalyst finally triggered, when they added liquidity into the coin, when big KOLs started to talk about it. That's how I caught this 100x move. And when this massive crash happened, when Dracula announced that they were disassociating this coin from actually having utility in the app that they were building, I cut. That was my invalidation. Yes, I round tripped a bit, but I made a shitload more than if I were to just go off of price alone and sold for maybe a 4 or 5x just because I felt like it. Because remember, you are here to capture the move rather than buying the actual bottom and selling the exact top. In a volatile market, and honestly in any trading space, capturing exact prices will only mess with your head. If you are truly convinced in a coin playing out the way you think it will, as long as you are capturing the move, you should not worry over exact bottoms and tops. One way you can work around this is by averaging in and averaging out of coins instead of buying in all at once. Literally what I did for video. You can see a ton of different sell points right here after my catalyst triggered. And when exiting on coins, you as a trader will fall under two categories. You will either 1, scale out, securing your profits along the move, so you're prioritizing more consistent gains and slowly exiting your position at each price target. For example, if your base target hits from the first catalyst, you'll take out 30% of your position. Then as the coin keeps running, take more and more out, and once your stretch target arrives, you'll be almost fully exited. You're playing it safe. This is perfect for coins when the sector seems like it's leaving the initial euphoria phase and entering fatigue. Or if your psychology simply prefers consistency and safe profits, you are sacrificing profits for less risk. Or the second trading style, you're holding for max reward. You're prioritizing massive reward and holding for the entire move to possibly play out instead of exiting between catalyst targets. For example, if your base target hits from the first catalyst, you'll hold your entire position until stretch hits, or take a really small amount during stretch and look for that moon target to play out before exiting any significant amount. And this is great for coins when the sector is at that initial euphoria phase with loose ceilings and a bullish environment. And understanding your nature is extremely important as a trader, and staying within your nature is how you become a great trader within your edge. This tweet by Itai, one of the best on-chain traders of this cycle, you should definitely drop him a follow. This is Twitter right here. IT4I captures what I'm saying perfectly in his pin tweet right here with his analogy of the fish and the monkey. He says, I believe we all have a trading nature. Some are fish, they aim to reach the shores every day. They prioritize consistent gains over life-changing stories. Others are monkeys. They want it big, they want it exciting, and the first step is understanding your core. Once you know your nature, the next step is to stay loyal to it. And loyalty purely means avoiding useless cope. If I'm a monkey, I don't cope over round tripping. If I'm a fish, I don't cope over paper handing moonshots. And when you truly own that, you can start adapting to stages in the market as different markets reward different breeds. A fish can stay a fish, but in a believer's market, aka initial euphoria, he might add, always keep a 10% moon bag to his system, always keep a 10% position on your coins. And a monkey can stay a monkey, but in a Jeet market, in fatigue and cooked phases, he might add, always secure initials to his system. But fish cry on trees, monkeys scream in the ocean. Keep loyal to your system, or be, I can't say this word out loud, but basically be fucked by the cat. If you keep flip-flopping between trading styles, you will never get to a point where you can actually capitalize and start making money off of your trading style. And now that we know how to quantify our reward, finding those gaps in price by tying our coin to catalysts, and quantify our risk, cutting our position at narrative invalidations, not price, we can simply tie all those specifics together and boil risk to reward down to asking ourselves whether the trade is plus EV or minus EV. So is there going to be a positive expected value of us taking the trade on that coin, or is there going to be a negative expected value of us taking the trade? And you don't need a spreadsheet and calculate statistics to know whether a trade is plus EV. The logic is very simple. A trade or your position in a trade is plus EV if the base target, your most conservative target, still pays meaningfully more than the risk to invalidation and can happen within the sector window. And if there are multiple ways to win, there's 2 or more realistic catalysts, a wide audience that the coin's narrative appeals to, and a few clean, easily identifiable ways to lose. A trade is also more likely to be plus EV if you can describe your exit liquidity, the buyers who will buy 2 to 3 times higher, and very boiled down, your current position stands more to gain from the next catalyst that occurs compared to the scenario where the coin completely rolls over. Now, a trade is likely minus EV if your thesis needs an unlikely or a miracle catalyst just to hit that base target. Or a trade is also minus EV if the catalyst for the coin is crowded and likely priced in. You're hoping for the same result as everyone else. So if you're reading a tweet, if everyone expects to sell when something happens, there's not going to be much buy pressure in that coin, right? And a trade is also minus EV if your first believable tier, your base target, only pays marginally over your risk. So the catalysts you've built out are just not significant. And boiled down, you can just think of a trade as minus EV if your current position stands to gain less from the next catalyst that occurs compared to the scenario where the coin completely rolls over. So for example, during that period of the 200k buy on Clanker that my student Kai identified, we saw a couple $1 million increase in market cap on Clanker, a coin that had no catalyst triggering for months. It was just chopping and downtrending, and after that 200k buy triggered and the catalyst started to become much more realistic, there's not much downside from the range that formed during that buy to where it was right now, the invalidation right here. This was an example of a plus EV trade. Not very much to lose, we could just cut it right here, and if our thesis played out, we'd have an insane amount to gain. Plus versus minus EV. Do you stand to gain more or less if the coin just completely rolls over and you get invalidated? And while every single point that I just listed is very clear, simply comparing how much you have to gain from a realistic catalyst occurring compared to how much drawdown you possibly need to stand, I really want to emphasize the last points on both plus EV and minus EV scenarios. My point on is there significant enough upside? Remember, you are always in a temporary market, a cycle. Are there other possible coins that will outperform your position within the same/smaller time frame? The bottom line is, would you buy the coin your position is in at its current market cap? If you won't, it's likely minus EV to stay in that coin. Remember, you are not an index fund and you don't have infinite capital to play with. You need to pick a small handful of winners. In fact, diversifying across a lot of coins is actually pretty bad in crypto. Remember, a rising tide lifts all boats, even the ones with holes. When a sector catches liquidity, every coin in that sector will go up, but they will all ride it in different ways. Your job is to find the boats without holes, the top performers, and concentrate your capital on them. Be selective. Don't just spray and pray. And a very solid framework that I use within the concept of risk to reward, planning out entries and exits by phase. Very simple concept. Generally, you want to tie your system of risk to reward according to the sector cycle. And I kind of talked about this in quantifying reward. On Itai's quote, a fish can stay a fish, but in the believer's market, he might add, always keep a moon bag. And a monkey can stay a monkey, but in the G market, he might add, always secure initials. So in early euphoria, you are in an extremely bullish environment. You can be lenient with risk and focus on reward. So for entries, you can be very loose with them and more loose with narrative analysis. The coin will likely pick up buy volume anyways. And for exits, when you're scaling into starting positions, you can hold longer for runners if the leader of the sector is still intact. And remember, your stops here are going to be narrative focused, not arbitrary percentages like sell 50% on 2x that goes completely against what I've been teaching in this entire course. And in the later stages of a sector, as it goes closer and closer to cooked, you are entering a more and more bearish environment the further down the curve you go. Selectivity and playing defensively is rewarded in this scenario. And for entries, you might want to enter on coins that have proven themselves to be more established with catalysts that already played out in the past, or coins with only the most realistic of catalysts. And you can be more strict with your exits. You're protecting capital here. Of course, I did generalize a lot of the framework here just to make it easy to understand for you, but the idea is clear, right? Euphoric market equals risk off and bearish market equals risk on. And a good exercise you can implement for knowing when to cut your bags is what I call this counter catalyst exercise. So every time you think about entering a trade, list the top 3 things that could ruin this trade before your catalyst plays out. So for example, number 1, the coin you're in sector leader printing a lower low even when there's heavy volume. Number 2, a competitor with a stronger narrative announcing a product upgrade first. And number 3, your catalyst getting delayed past your window. 3 very generic examples I just gave there, but the point should be very clear. Coming up with any 3 invalidations for your trade is just going to make your entire thesis much more clear and much more easy to understand for you. And for each one, another thing I like to do is writing my reaction in a single sentence. So reduce, exit, or wait. And for each counter catalyst, if you can't name the reaction now, you're probably not going to make a good decision later. Okay, let's zoom out for a second and just talk about the edge that we've created now for you. By now in your journey, you've learned where the tide flows, so sector flow. You've learned which boats deserve your capital, narrative analysis, and now you created a system to decide the payoff of your trade, size intelligently, and exit your winners, so risk to reward. And with everything in mind, you need to remember that the purpose of understanding these 3 steps is the same: finding your edge, finding your repeatable advantage that you earned by thinking for yourself and executing your thesis that you wrote down. And you probably have some kind of idea what edge you might be exploring when finding and valuing your coins by now after understanding the 3 concepts I talked about alone. And I've watched it happen over and over again. My students coming into my mentorship unsure where to even start, but once they dialed in their edge using this framework, everything clicked. They stopped second guessing every move, positioned themselves with confidence, and turned their setup into profits like these. And in the final stage of finding a good coin, I'll zoom out one last time and show you how to exactly use these 3 steps to identify your personal edge. The exact style of trade that fits you and how your profits trading crypto will look like. And this is going to be the final piece of actually finding profitable coins while everyone else is just going to be still blindly following other people, getting rugged, and then wondering what the hell is going on. So not everyone is going to be the same, but now you know every advantage has the same underlying framework. So you need to pick one to specialize in and master, and then consider any others that you might favor later. So some examples of your edge could be a predictive edge. So you love context, you watch macro cues, leader structure, launch quality, and your win condition is just sizing early before the crowd and letting the rotation itself make you the money. Some key drills for this could be tracking previous sector flows and what caused them, writing sector theses regularly and logging catalysts and counter catalysts. And here, being right is more important than the money you make here. This is a skill you need to hone continuously. Number 2, a reactive edge. So you're someone who likes to trade fast. You scan new launches and what makes a coin, quote unquote, established within that first initial phase of euphoria in a sector. And your win condition is simply going to be processing information faster than everyone else and acting just as fast in that initial window of euphoria while ceilings and valuations are still loose. And this is going to be very interrelated with the skill of narrative analysis. So some key drills for this could be tracking what constituted an quote unquote established coin in previous euphoric sectors, and anytime you get into a phase of initial euphoria, pre-writing your filters and keeping rules of when you are entering and when you are exiting. Or you could also have a laggard edge. You love comparing valuations, leader to the main driving narrative to the consequence narrative, and your win condition is going to be you catch coins with narratives that seem undervalued compared to the leaders and other coins within the sector. So you're predicting possible outperformers as they sort of re-rate towards a leader in their respective phase. Or you could have a narrative discovery edge. So you love doing extensive research and you're just overall looking for coins with powerful stories and strong storytellers. And your win condition is you buy before the story hits the market. And key drills could be building narrative theses on every coin you see, asking who buys 3 times higher, and avoiding crowded coins and priced in threads, tweets, catalyst. You're doing your own research. And by now you can see every single edge is going to be interrelated with the 3 concepts that I talked about. If you want to decide on a trading style that fits you, you need to know sector flow, you need to know narrative analysis, you need to know risk to reward. And once you've figured out a style, state your edge out loud. I trade early euphoria laggards in hot sectors with doxed builders and a dated catalyst, and I'm gonna always scale out at base tiers and kill my coins the second the leader shows weakness. Obviously, all these edges I just gave you are just very few examples, right? There's going to be an infinite amount of ways that you can find an advantageous angle over other market participants, but that's up to you to find out through your experience and keeping the 3 concepts I talked about in mind, putting in the hours, actually doing research on coins, and trading on your own. You're not going to find your trading style right away, but at the root of it, notice how all of those advantages have the same framework, but just different, distinct win conditions laid out. This is why I went over sector flow, narrative analysis, and risk to reward. You need to know these 3 extensively. I really want to emphasize this in order to actually find out what you're good at. If all you do is sit on Axiom all day and just buy coins off vibes, you are just like everyone else. And guess what everyone else is doing? Donating liquidity to the market and complaining about it on Twitter, while also bull posting saying that, oh, everyone is going to be rewarded someday. In a zero-sum market like crypto, this physically cannot be true. You need something that will allow you to identify profitable coins before everyone else. But just as important as finding your edge is staying loyal to it. It takes time, practice, and effort to build a skill. You cannot just willy-nilly change your edge whenever the market changes. The market is always going to change. This is how you burn your hard-earned money, just constantly rotating into whatever you feel like based on your emotions. You are not going to be good at everything, so be good when it counts, because surviving long enough is an edge. I want to make this extremely clear. A big reason why I was able to break all those examples down was that, well, I was there when it happened with enough money for it to matter to me to actually focus on what was happening. That alone eliminates most of your competition who just jump in, make fast, easy money, then just get burnt when the market turns on them unexpectedly and then they just give up. Survive long enough with enough capital so you'll actually pay attention to the market and you will be rewarded in the future. As a final note, and this is something that's been spread throughout the 3 steps of finding good coins, but I really want to emphasize this, your edge is always ever changing. The framework stays the same, like I've been constantly pointing out, yes, but the information you're going to be working with is going to change every time. New sectors, new leaders, new catalysts, new narratives. What worked last month isn't going to play out the exact same to a T this month. Your job is to always train your edge and stay updated with the market and the timeline so your edge always stays current. Remember what I said about differing sectors and coins. Everything is situational. The information you have at the moment, the narratives that are hot this moment, the catalysts that you're waiting on this moment, everything is going to change in the future. And because it's temporary, you want to always abuse it when it's open and just rotate it when it shuts. It's a window. And the traders who do well don't do the same thing forever. They keep the framework, refresh whatever inputs they can find, and just move on.
Okay, you've done the hard work. You found the tide through sector flow, and you've handpicked a few boats with real stories, or you know what boats to hop on and react to. Here's the twist that a lot of these traders miss. A great story doesn't automatically deserve your capital. 2 coins can share the same narrative and live in the same hot sector, yet one just grinds upwards, printing a 2x, 5x, a 10x, while the other just chops you to death. Why? Because price, timing, and path can compress the upside until the trade just isn't worth it anymore. Think about 2 revenue cryptocurrencies with very similar narratives. That revenue protocol coin with a clean story, is it sitting at a $5 million market cap after a feature integration with no realistic catalysts and a sector leader that's starting to chop? Or is it at a $5 million market cap with a clear catalyst within the next month and a sector leader valued at billions? Very similar narratives, but very different payoff. One gives you a narrow, maybe 1 to 2x window with a high chance of getting clipped by a sector pullback, and the other is undervalued with room to re-rate. Until you price the story, map your counter catalysts, and plan exits that are tied to catalysts, not just going off of your vibes. you are gambling. Because here's the uncomfortable truth. Even your best score narratives may be negative EV at today's price. And those arbitrary exits, sell 50% when green, are why strong narratives still round trip. So, step 3 is where we separate good stories from good trades. We're going to price the story, size the bet, and script the exit before we even click buy. You're going to learn how to set targets off catalysts, when to average in and out to capture the move and not just catch exact bottoms and tops, and how to kill a trade the moment a counter catalyst hits.
Step number 4 in my course is going to be risk management. Why most traders blow up. And a lot of newcomers in the space think that port blowups come from bad calls or the wrong coin. They're wrong. Okay? Blowups come from poor risk management. And if you know anything about the trading space, not even just crypto, you probably heard this term a million different times. And I know it sounds like generic guru talk, but you can be right about the sector. You can have your entire thesis dialed in. You can even have a leading win rate on your trades and still lose everything if your size and your security are wrong. Oversizing on trades, blind trust, letting your emotions take over. This is not something I'm just pulling randomly out of my ass, but from my personal experience.
Okay, you now know where and when to trade and how you win. But the only way this turns into a long career is if you can protect your portfolio while you maintain your edge. Two traders can have the exact same trading strategy, yet one can end up losing everything and the other into early retirement. In the next section, we're gonna bolt on keeping you in the game. So through wallet structure, sizing, exit mechanics, and operational security, so making a single mistake never erases months or maybe even a year of good decisions.
With actual rules and a framework in place, you can survive 5, 10, 20 losers in a row. The second you start trading without them, you are at risk of a single mistake, putting you back months to years of progress. I mean, we saw it in the liquidation cascade on October 10th recently. Over $19 billion in leverage positions wiped out. Anyone who even touched leverage and stayed in it got absolutely murdered. Even experienced traders, people who have been in this game for years and years and years, completely wiped out portfolios. Even people who were building them since the last cycle of 4 years ago. Remember, when you're trading crypto, you're not just dealing with a loss of money, right? There's time you could have spent with your friends and family, time you could have spent learning another skill. There's a massive opportunity cost here by choosing the path of crypto. And every single major loss I've experienced in my journey so far, I got a massive pit in my stomach whenever I refreshed my portfolio and just saw my money gone. And the shame of having to redeposit because I got greedy. It's not a feeling you forget for a while, no matter how badly you want to move on emotionally. That's why I'm so strict about risk management now and dedicating this section to it, because I genuinely want you to never have that same feeling. So, if risk is the real reason people blow up, what single rule prevents it most reliably? Well, that is the golden rule, and say this out loud with me: every position I open and every dollar I leave in crypto is already zero. On paper, this seems very easy, but in the moment, it's unbelievably hard. Your brain's gonna argue, not this trade, not this setup. You are just letting FOMO get in the way. So the first thing we're gonna do is make this rule real by building some small but very important habits. So to start off, we're gonna build a rehearsal habit. Before you click buy, just picture your position at zero and ask, would my current quality of life be affected if I lost every bit of money in this position? If the answer is yes, you are oversized, my friend. Reduce it no matter how bullish you are on the trade. And this also means that whenever your position changes, let's say it goes up 5x, right? You do not include that 5x position as a part of your net worth until you actually exit. It's still zero. And something that really helped me at the start, it's kind of funny, but it was naming my main trading wallet already zero. This way, I was just constantly reminded of this golden rule. And another important habit, back to our thesis and validations that I've been talking about for this entire course, have either a card tape near your screen or on a doc that you check regularly. Yes, I want you to do this physically and ask, number 1, when do I cut? And number 2, who buys it higher? If you can't answer these in just one sentence each, you are not allowed to enter that trade. And thinking this way is going to make you do the right things automatically. You only size in the trades what you can emotionally and financially lose. You set invalidations before entry and actually cut when they hit, and you plan exits on your winners in advance instead of just inventing some random catalyst mid-pump. And once you at least have this mindset of assuming zero at the back of your head, we can actually build some structure around how you interact with the market, starting with your tools. Now, just belief isn't going to be enough, right? Before we continue with any frameworks, we need to ask ourselves, what actual physical infrastructure helps us keep this rule in mind, because a lot of blowups actually start with the wrong tools, anonymous bots, random snipers, sketchy links. So when we're trading, we're going to only use professional terminals that reputable accounts and influencers on crypto Twitter are using. For example, for trading on-chain coins on Solana and BNB, we are going to use Axiom Pro because it's a real company with a verifiable team and audits, and they're backed by Y Combinator, the leading startup accelerator in the world. And for trading terminals, Axiom Pro is pretty much the safest bet that you can take at the moment. Now, I'm not saying that there aren't janky tools out there that can help you make money. I'm saying that when these janky tools fail, they fail catastrophically. Crypto drains from suspicious products are one of the leading losses of money in the space. It's the same exact thing as following a random call you're getting on your phone about a fishy investment. Whatever kind of money you put into that thing is going to shit. So keep it simple. Established tools only. No extensions, no secret tools that no one knows about. And this is so important to keep in mind because historically, like I said, when market conditions worsen or as we get deeper into the cycle, you get all these janky trading bots ran by anonymous teams draining all their users out of nowhere. And no one can do anything about it because they're all built by anonymous people. And even on the more established trading terminals, treat the money you have in them like it's non-existent. The golden rule doesn't just apply to your positions, right? Because remember, the whole point of crypto is actually owning your wealth. If it's in some third party, it's not truly yours now, is it? So this also means that you should not be keeping your money on any centralized exchanges, not even the established ones like Coinbase, and especially not smaller ones. Do not use these CEXs as some kind of vault. Only use them to buy crypto or to bridge. Same exact thing with janky trading bots. Smaller exchanges especially are notorious for withholding user money during poor market conditions. And the money that you do hold should be made as secure as possible. For example, for your stable coins, don't just have it all in one protocol. So all of your stables shouldn't just be in USDC Sol. Keep some in USDT, keep some in USDC ETH. If a single chain outage happens, you don't want to get caught with your pants down, right? Technology isn't perfect. I think a good way to really emphasize this is that you wouldn't walk through, let's say, New York City with your life savings in your back pocket, right? Don't do it digitally either. It's not just crypto. The entire society we live in is just absolutely ruthless towards finances. Now, you know where you shouldn't be keeping all your money and to never stash it in one place. But now you're probably asking me, okay then Alex, how should I best allocate my capital? Well, we do that by segregating it into established areas with limits in each one. For the first area your capital should be in, hot wallets and trading terminals, your cash in pocket, only what you need today. The first area is going to be in your hot wallets and your trading terminals. So Phantom Wallet, Axiom Pro, BaseBot. This is going to be your cash in pocket, only what you need today. 1 or 2 wallets max. If this vanishes overnight, you just move on with your life. Your quality of life isn't really going to change, right? And when you're practicing this, set a daily balance ceiling alert. At the end of, let's say, every trading session, auto sweep anything above past whatever limit you set. Let's say 50 Sol, right? Anytime you hit over 50 Sol in your trading wallet, move it into number 2, your cold wallet. And if you don't know what a cold wallet is, these are going to be physical wallets that keep your private keys offline. So Ledger is a good one. Trezor is a great one too. I personally use Trezor. These are physical wallets that you can hold your money in. Because let's say when you get attacked by malware, right? It's your entire PC getting hacked into. Your cold wallets in your PC are not going to be safe. But if it's stored offline in a device with the sole purpose of just holding cryptocurrency, that physical wallet that's outside of your PC is going to be safe. Now, obviously, I probably don't need to tell you this, but keep your cold wallet private keys offline. Same thing with any other private key that you get from your hot wallets as well. Keep these all offline, written down physically. Do not store these in Google Docs or anything online. And your cold wallet is going to act as a cryptocurrency vault, right? These are going to be for your longer term holds that you're not going to be touching for a while. This is going to be for your larger holdings like majors, Bitcoin, Solana, Ethereum. Like I said, whatever you're not going to touch for a while, or whatever crypto you're currently holding and not trading with at the moment. And finally, the third place is going to be a fiat buffer. So this is going to be cash in a bank for rent, taxes, emergencies, because absolute worst case scenario, doomsday for crypto. If everything on chain disappears, you're still alive and kicking because you have real cash to work with. I wish everything was decentralized, but unfortunately, not everything in the real world is going to run on crypto. So you need cold hard cash. And I used to have a ton of money in hot wallets just in case, an opportunity came up, and a bunch of different hot wallets as well for different purposes, never really organized them. And that laziness cost me $1 million. Now my hot wallets are strictly for trades I'm placing today. Okay, now our capital is organized much safer, right? We've now hedged for the absolute worst. If anything does happen, knock on wood, you're gonna be much better off. Next, let's talk more about managing risk on our actual positions. And while we went over actually executing your trades when I taught you risk to reward, we're going to mainly focus on maintaining a healthy sense of risk for when you're executing. And the main point to keep in mind here when you're sizing into trades is the golden rule. Imagine your position at zero. If your rent, taxes, or mental health is going to get hit, cut your size. And a really good quote I've seen that highlights this, I wasn't able to find it, but it's just been stuck in my head. If you're completely emotionless about your trade, you have too little in. If you're panicking and checking it every second, you have too much. This way you're always on your toes. You're going to be doing active due diligence, but you're not going to be losing your hairs on your positions, right? Some other ways you can maintain your risk on your positions is by forcing yourself into selectivity. If you can't build an extensive thesis and fill in the risk to reward sheet I mentioned earlier on a coin you're looking at, move on. I've watched friends turn $1,000 into 7 figures on generational coins and then lose it by oversizing the next several trades because they get overconfident. I've done this. If you don't respect size, the market's gonna teach you. This is really where setting a kind of quote unquote set balance, which I talked about when segregating your capital, can help you. Make a set number for how much money is in your trading wallet. Let's say 50 SOL is what I used as an example before, right? If it goes over that 50 SOL, you move that money out into your cold wallet ASAP. This way you're forcing yourself to maintain healthy sizing. And once you have healthy size into your position, remember to not work with arbitrary percentages. No selling 50% at 2x bullshit, right? You are a smart person. You work with narrative invalidations only. Why? Because if it goes to zero, it's not going to be enough to hurt you anyways, right? That's why we need healthy sizing before we even think about entering into a trade. So implement an if-then perspective for all your trades. If X happens, then my catalyst Y is much less likely to happen or not going to happen, and therefore I'm going to cut my position Z. And for my final point on this, and I know it sounds a little bit contradictory from the whole arbitrary exits I told you to stay away from, but keep in mind, you're still a real person with real responsibilities as well, right? If taking profit on a position is enough to change your quality of life, or you have bills, family responsibilities due, go exit, go take some profits, and take care of those first. A clear head from your personal life is always going to better you in the long run on the charts. But all the discipline in the world on only your trades is not going to save you if your wallet gets drained or your money gets stolen. The security of your money is just as important as how you make it. So let's set up some measures. We're going to change hot wallets every month. This way, in case any of your hot wallet private keys are at risk, your money will be on a new wallet anyways. And we're going to store most of our money in cold wallets. Like I said, a physical wallet is going to be the safest way to store your money. And don't keep a significant amount of money any exchange. There are ways for you to buy crypto and bridge, but they're not going to be banks. Now, when you're transferring crypto, you're bridging, you're selling, don't do it all at once. Do a confirmation transaction and then transfer it into portions. Let's say I'm making a new wallet and I want to send 100 SOL into it. I'm going to send 0.1 SOL first to see if I'm sending it to the right wallet or not. And distribute your money across different chains. I talked about this at the very start, buying crypto on different chains. Don't just pick one to trade on like Solana. Not only will this make it harder for you to get wiped in one go, your money's going to be split across different wallets on different chains, but you'll also be ready for any opportunity. For example, if an opportunity on Ethereum comes up, but all your money is on Solana, you might be too late by the time you bridge. And whenever you're trading, assume any money on trading bots and terminals as zero. Golden rule for everything. And have a separate device dedicated for trading only. I talked about this on the setup stage. Don't download anything, don't join any calls, don't accept any messages from someone you don't know, don't click on any links you can't confirm. And speaking of calls, don't ever join any third-party calls. Zoom, Google Meets, Microsoft Teams, on any device you have money in. If you watch my video where I talk about how I got drained for $1 million, this is exactly what happened. I joined an official Microsoft Teams link, and they had some advanced malware that got injected to my PC the second I clicked on that link. I scanned it through every antivirus system out there. They detected nothing. So double check everything. I've seen it so many times. I've seen people get DMs from someone pretending to be me and get scammed when all they could have done is see if the username actually lined up with mine. There'd be some M dash or a letter or a number in the middle. And most importantly, stay paranoid and stay humble. Getting overconfident is a security issue. The second you feel like you've gotten experienced and stop being cautious of everything is the perfect window for the worst to happen. If you feel scared after everything I just ran down, that's exactly how I want you to feel. Always stay on your feet and do whatever you can to survive in this space. Now, even with everything I said, fully implemented, you can't outright prevent loss, right? You are going to slip up and make some losing trades along the way, or you'll even have a great thesis planned out the whole process through and still just lose due to unexpected factors, right? You can't help that. But as long as you survive and keep the frameworks I taught you, you will come out in the end, because survival itself is an edge. So many market participants make easy money during euphoria phases, give it all back during fatigue, and then quit. I'm going to tell you right now, my best personal edge in the market is reaction. Most of my money has not been made from actually predicting huge flows of money into a sector. I have traders on my research team who excel at that, but me, I'm a better trader when that phase actually triggers. This means I'm going to be really good at being patient for these initial phases of euphorias to happen, go all in when they do, and have the analytical skills to identify what coins will have strong narratives in the eye of the market. You want to know how I'm able to understand my edge and break it down, knowing how and when to act, and actually executed on it to make myself money? Because I was there observing this pattern in the market and noticing these little details time and time and time. I had enough money in my pocket to force myself to be attentive to these scenarios and physically recorded any moments that blindsided me or ones that I didn't expect to happen, causing me to end up negative by the end. I outlasted everyone else in the market and paid attention. These patterns are obvious to me now because I survived. If you're still here with enough capital to care and calm enough to think and observe the market, when the window for your edge appears, you're not going to need luck. You will have an edge and you are going to have capital. You will come out on top. So whenever things don't go your way, physically write exactly what happened. Number one, identify which rule you broke of your edge if that's what's caused you to lose. Number two, track what actually happened if it was from an unexpected event. Trading is a war of attrition. You don't win with one lucky bet. You win by surviving long enough to compound and being around long enough to learn how to think for yourself.
I literally lived this. I got drained for $1 million if I was just slightly more paranoid or simply been more organized with the money in my wallets. I wouldn't have lost even a fraction of that amount. And even at the very start of my journey, like I told you, my first $500 and the next several deposits after, I only lost my entire portfolio at the time because I full ported the several coins I saw that I thought were decent. And even the first 6 figures I made, I turned $500 into $104,000 4 months into my trading journey. I knew how to find good coins, and in just a month after, I round-tripped it to 18,000 because I was trading like I had infinite money and I was oversizing on my positions. I am a walking definition of how it's easier to make money trading and investing in crypto than it is to keep it. Risk management is so boring, right? Who wants to hear about money management? All the fun is in making it, right? But it's the only thing that'll keep you grounded in a volatile market like crypto, where on one side, everyday people are making millions, and on the other, the same people are losing the same amount in just a few plays. Okay, now you've built a fully fleshed out and real system. You know the trading tools you'll be using, you understand the 3 concepts of finding good coins and actually capitalizing on them, and you know proper risk management in order to stay alive and find your edge. But why can 2 traders with the exact same systems run the same play, same edge, and end up with different results? Same setup, same sector, same coin, but a different mindset. This is why we need to talk about step 5. Trading psychology. Okay, so trading is a psychological game. You've probably heard this a million different times by now, but what does it actually mean? Well, when it comes to trading crypto, it means that everything, your edge, how much money you make, the end result of it all is dependent on your mindset and emotions. So for this section, I'm gonna give you the secret to mastering trading psychology and just make it super practical for you so you can implement everything that I'm saying into your trading system. An actual set of behaviors that you will be able to repeat under stress, and it all revolves around 2 mentalities: discipline and purpose.
Let's start with discipline. So everyone has different definitions for discipline, and I feel like this term, discipline, has been romanticized, oversimplified, taken up, down, sideways, but all it really comes down to is simply doing what you said you do and doing what you don't want to. So what does this mean in the sense of trading crypto? It means having discipline to your edge. So staying in your lane. You are not going to be good at everything. Keep observing the pattern, tracking down patterns until you can realize an advantage that you will have over everyone else. Like I said, my personal edge is sector reaction. I'm great at noticing when a sector goes into initial euphoria, identifying what narratives narratives will outperform at that phase, whether they're undervalued, and a rough estimate of what these narratives should be worth and how long the window will last, so I know how long I can abuse my knowledge of what makes these coins, quote unquote, established. When it comes to sector prediction, okay, I admit I'm not the best there is in the game when it comes to predicting macro. This is a skill I'm always improving every single day. I'm continuously improving this skill, but I make sure to stay patient and put more of my balls and my capital on the line when it comes to reacting to these micro bull cycles inside each sector. That's why trading on chain fits me so well. I know what I'm good at and I stick to it. Become a specialist in your field. You will make infinitely more money by being good at one thing than being mediocre at everything. Like they say, a jack of all trades is a master of none. If a setup doesn't fit within the frame you've got of sector flow to narrative to risk to reward that you've already built out, it's not your trade. No matter how much, no matter anything you see on the timeline about it, all the noise, it's not your trade, okay? Now, being disciplined also means having discipline to your thesis with no hesitation. Don't rely on your emotions when it comes to taking a trade or not taking a trade. I mean, by now you should know this, right? Have a thesis written out and pre-commit your actions. You want to know why most people hesitate before taking a trade? Because they don't have anything planned out before they take one. By actually building out a thesis, you know exactly what to look for in a coin and how to act when it happens. You are planning your actions beforehand. I am buying into this coin because I believe X catalyst will happen, and when it does, I'm going to take Y% out of my position. By building out a thesis and thinking like this, you should have no hesitation whatsoever compared to someone who waits for a lower entry to buy into a coin, and then when the lower entry comes, they think, oh my fucking god, oh shit, the coin actually looks kind of weak here, maybe I shouldn't buy. You know exactly what you're looking for, right? And when you're up on a position, you're relying on actual fundamentals and structure for when you take profits. You know what you're gonna do before you even do it, and that creates discipline. And building out a thesis, if you've gotten this far, I know it seems like extra work instead of just going off of your vibes. It's tiring, right? It's work, it's extra work, but that's what discipline is about, doing what you don't want to do. And this also means you need discipline in your life and routine. If you can't keep promises to yourself outside the charts, you will not magically 180 your psychology in front of a screen, right? Fix your life and your trading will reflect it. And personally, I found that the best way to do this is to have at least 2 daily habits that will better you as a person that you will do no matter what. These 2 things can be big or small, it doesn't matter, right? One of them can literally just be doing your bed in the morning. What does matter is that you stay disciplined and actually do them, right? For me, that was going to the gym and eating at least 1 healthy meal a day. Even on the days I'm staying up, it's euphoria and I'm trading 18 hours a day. I get these 2 done no matter what. I did them at the start of my trading journey and I do them now. It really doesn't seem like much, right? But what these small wins do is that they constantly validate your discipline. It's pretty much you manipulating yourself saying, I can get these 2 things done no matter how I feel. If I feel like shit, I'm tired, I don't feel like getting out of bed, doesn't matter. So I can do the same on the charts. And these seemingly tiny things are what build your character. And trust me, this is something that's not just going to be affecting your trading, but anything you ever plan to do in the future. If you want to do a startup, if you want to branch out into another field of entrepreneurship, do this for 2 weeks and please just watch how much easier it is for you to follow your trading rules. Why? Because by doing this, you are brainwashing yourself, telling yourself you are a disciplined person who respects themselves, who gets shit done. Now, what might seem a little contradictory is also having discipline in your greed. Greed is not a bad thing in crypto. It's why you see people who you think are absolutely morons at the top. But because of this insane level of greedy delusion, they're able to believe whatever thesis they were able to come up with, and it plays out. In a competitive field like trading, greed is not the enemy, but aimless and uncontrolled greed is. If your P&L on a trade is enough to improve your quality of life, right? Clear debt, free of family responsibilities, take profit, things like these, current impacts on your real life is more important than money. Money isn't everything. And remember, noise is the biggest enemy in crypto. This is the leading cause of FOMO. If it doesn't fit your edge, if it strays from your thesis, don't greed in, it's not your trade. And if you do turn $1,000 into $1 million, right? Whether it happened out of luck, whether it's from you following your own thesis, you are not a god, okay? A successful trade is a result of your thesis playing out. You don't magically get better on the spot, okay? So don't suddenly go sizing hundreds of thousands of dollars into your trades, or something even more stupid, like thinking you can just flip-flop and change your edge if something just looks free out of nowhere, or even more stupid, something I see a lot of people do actually, magically switching to perps when the market is down. In trading, most of what you're doing should be pre-planned, size included. Don't go magically changing or venturing into something you have no experience with if that's not what you're here for. And the best way you can accomplish every framework I just talked about regarding discipline is by keeping yourself accountable, having discipline in your accountability. I'm going to tell you right now, I personally didn't capitalize as much as I could on the BNB sector explosion we saw. Some of my research team made generational wealth amounts, but me personally, I got a little lazy. And as a reactive trader, that pissed me off beyond belief. So what did I do? I admitted that I fucked up, that I didn't make as much money as I should have, and I wrote down how I could have capitalized it on it better. Being more attentive of what narratives BNB, the Chinese audience of crypto, liked. Putting more time into the market than just sitting easy on Solana and EVM waiting for something to happen. Adjusting my sleep schedule to China's time zone. You should feel depressed. You should feel angry when you miss out on something. Take accountability and learn from every mistake you made. If you missed massive plays in the past like Trump coin or any AI coin during AI sector euphoria, figure out what went wrong, because after taking notes on cycles, you now know that you will only have so much time to improve every single time. So ask yourself, what rule did you break? What did you fail to catch? Now, what could you have improved on? How can you make sure you stick to your improvements in the future? But how do you actually become more disciplined? How do you hone your edge? It's very simple, and actually something I've been emphasizing all throughout this course, right? Journal. Write everything down physically, pen and paper, Google Docs, notes, whatever. Have it written down. After you take a trade, write down every single step of it. What was the narrative of the coin I bought? What catalyst was I expecting? Why did I hold for how long I did? Why did I sell where I did? What is my trading style? Am I reading the next sector or pressing the current one? And these are just some personal journaling examples that I use. You can even go beyond this to whatever works for you and will keep you accountable and document your journey. Just know that the more you put down, the better. Nobody's perfect. I'm not perfect. I have instances where I look back and I realized I could have executed this much better. And by journaling, you always know where you are as a trader in terms of your skill. You know your edge, and if it's working in the current market conditions, it keeps you humble, grounded, and always on your feet, and you always give yourself room to improve as a trader. Trading is a process. The market is always going to be changing, and you need to keep up with it. So many people expect overnight success and that a single coin will make it happen, and when it doesn't, they just give up. That's not the reality. It's the traders who can actually think for themselves, find their edge, refine it, and learn from their mistakes, who always come out on top at the end. But simple dedication just isn't enough for most people. Instead, what will help with being disciplined and fuel it is having a purpose. Every trade you take from now on, ask yourself why you're doing it. Let's say half a year in, right? You're down 80% from your portfolio, all-time highs. I want to say knock on wood, but every trader is going to go through an event like this. There's no way around it. You will get a lucky streak and become overconfident. It's human nature. You start thinking back on what you could have done instead, how you should have measured your risk better, how you should have respected crypto for the volatile risk asset that it is. And of course, all the sleepless nights you spent trading that could have been spent with friends, family, or on another skill set. And for me, that moment was during the post-war FUD market nuke of summer 2024. Prior to that, I was break even and negative for nearly half a year. I was spending at times 18 hours a day in the market while also trying to balance my classes because I was in Cornell University at the time. I then proceeded to turn my final $500 into $104,000 in less than 2 weeks during May 2024, only to round trip all the way down to 18,000 within the next month. I told you about this story already, but what I didn't tell you was that led to one of the worst points in my entire life. I stepped away from crypto. I was out doing bullshit with my friends every other day. I stayed up watching Game of Thrones and playing this game called League of Legends every day. Obviously, I'm more comfortable now, but back then, the real damage to me wasn't the money. It was my self-confidence as a trader. After something like this happens, you start asking yourself, was I just lucky? And worst case scenario, you start trying to chase it back trade by trade. Now, one of my biggest sayings I live by is, if I did it before, I can do it again. Whatever you did to reach a high point in anything, right? You don't magically lose the skills that built your all-time high, right? You either broke rules or you missed variables. So whenever I had events like these in my journey, I would always make two categories. Number one, what was I good at? How did I reach my all-time high? What was my edge? And number two, where did I mess up? You know, what rules did I break? What changed in market conditions? What did I fail to consider? For example, when I turned $500 into $104,000 in less than 2 weeks, I did it purely by scooping up a high percentage of new pairs on chain. I was sitting on my trading terminal. Back then it was Photon. Right now it's Axiom Pulse. I was great at narrative analysis, gauging ceilings on new narratives, doing research, and trading betas. What I'm best at now, right? During this period, on-chain was crazy hot, which complemented my skills extremely well. Where I fucked up, however, was trading the same risk-off style when the market turned over and volume died. And after I experienced consistent losses, I tried to make up for them by oversizing and got double crushed. What really got me through the mud in all this was a self-realization of why I was doing all this. Why I was putting myself through so much struggle before. Those nights I stayed up after that first 80% round trip, I would just sit down, contemplating if everything I was doing during my sleep was all I'd be doing for the rest of my life. Staying up playing video games, sneaking out, meaningless bullshit, and nothing to show for myself except my rank on League of Legends. I only got back into trading consistently once I started finding my why. Why did I need this to work out so badly? So my parents, who poured their blood, sweat, and money into me, wouldn't have anything to show but a NEET who just cared about video games and pretty girls. Why did I need this to work out so badly? So I'd be able to give back to my family and friends that have helped me get to where I am now. Why did I need this to work out so badly? So I wouldn't have to study for years, only to wage slave away for the rest of my life. And every trade I take is with these whys in my mind. If your only driver this entire time was just money with no context, that imaginary number in front of your screen, it's not gonna get you through these dark times. So right now, let's do a quick exercise. Imagine that you just died right now. No preparation, just died. What's the first thought that comes to your mind? Is it that you wouldn't have had anything to show your spouse, your parents, your kids? Is it that you wouldn't be able to support your family? Or maybe you just wish you could have had more experiences for yourself, but you probably didn't think of some arbitrary number in your portfolio or your account. That is your why. That is what you live for right now. And outside of any risk management advice, this sits in the middle of it all. If I take this trade, will it further help my purpose for living? Having a real goal in your mind will give you all the motivation you need to stay disciplined during slower times. A deeper meaning into why you're doing this will always keep you grounded no matter what you do. So ask yourself the question, why are you here? Why are you even watching my free course right now?
Because the reality of your crypto journey to making millions, buying that Ferrari, sipping champagne in your mansion is not as sexy as it sounds, because not all of you are going to make it. Pretty nihilistic view, but unfortunately, it's the truth. This is a dog-eat-dog world. This is a zero-sum market with winners and losers, where it's you versus everyone else. You are against people with experience like me. You are against institutions, VCs, people who have been doing this, extracting multi-millions from retail since the dawn of time. But pressure makes diamonds, and those of you who come out alive will possibly have a money-making skill that will last you a lifetime. And I'm gonna tell you right now to prepare you that this idealized image of trading crypto is gonna be mind-numbingly boring unless you truly love it. And this is from my personal experience, even during the beginning stage, where I started with $500, which I blew multiple times before I even made a cent. I was sitting in front of my laptop for sometimes 18 hours a day, scanning the market, discussing it with my best friend who was on this journey with me, doing research. You get the point. Now, obviously, I was an extreme case. There are successful traders out there who don't even log on for half that time, but I could only do that because I truly loved what I was doing. Could you imagine sitting in front of your screen for several hours a day, and I don't just mean zoning out, but truly dedicating yourself only to lose money, write about how you lost it, and then wake up and do it all over again? Because that's what it's gonna look like. You will be put to the test as a person in every possible aspect. Your skills, your discipline, your character, every step of the way, and you will completely transform for better or for worse. And it seems a little dramatic from what I just said could be a boring process, but you will change, and I've yet to see a person who hasn't. But if you are expecting some quick, easy, infinite money glitch to save yourself the time and quit while you're, quote unquote, ahead, I suppose. Trading in any form or market is never gonna be a get rich quick scheme. There's no single, silver bullet that you can just pick up and instantly be profitable with. If you cannot focus and devote yourself to one single thing and actually both put in the screen time and take action, this space is just not for you. Now, trading psychology is the final piece of actually turning whatever system you're thinking of into action. It's you keeping promises to yourself while the market just tries to talk you out of them. Implement the framework and questions I just gave you, and only then will everything you built in every step before actually compound. Now, before we end things here, just listen to me for a second. Most people never get this far. You know, they want magic indicators or stuff just spoon-fed to them. You chose the harder road. Thinking for yourself, building an actual system, training it deliberately, and surviving long enough for it to compound. That's the only way you will win in this game in the long run. And whenever things feel slow or you feel down, read this line out loud. I don't need to be perfect. I just need to be consistent. My edge is getting sharper every day I show up and try hard. So please, have faith in yourself, stick to your process, and just remember that I'm rooting for you. And hey, in my next videos, I expect your trades to one day line up with the exact case studies that I'm using. Screen time and actually putting in the hours yourself is just the most important thing when it comes to trading, so start experimenting. And I'm not telling you to go take a trade immediately after finishing this video. Absolutely not. And I know that after watching this, you will get the exact same itch that I had when I first started, right before I instantly blew my portfolio. But just go backtrack and look at previous case studies. You know, start building your own theses. But just to close off, I want you to envision yourself in the future. Think about where you'll be in 3 months. Tell yourself that you will be a changed person, someone with more financial freedom, someone with responsibilities. Actually, you know what? Say it. Right now, say, I'm the type of person who follows through. I'm the type of person who keeps showing up no matter how hard it gets. And in 3 months, I will be proud of the person I've become. Believe that you can do this. I know the journey will be hard. I know you will feel like the entire world is against you and that you can't handle the pressure. I went through the exact same thing. And if you've stuck with me to the end of this course, you've already proven to yourself that you can commit to the journey and devote time and energy into something bigger. You know what to do. You have the skill set frameworks, how to improve on them, and the mindset to make this all real. You just need to take the steps. I'll see you in the next one.